Hey, good morning, guys. Good morning, Rob. Good morning, Lyle. Lyle, did you ever get your email about the accounts? Just curious. I woke up thinking about that today. Morning, Miss Adriana. Nice to see you. Guys, happy Monday. Um, gonna be a good one. It's gonna be a great week. I can feel it. Feel it in my bones. Gonna be a good one. There's all the Monday shenanigans going on. They're sorting it out, figuring it out. Um, but it's going to be a good one. So let's start doing what we always do, guys. Let's take a look at news and make sure that there's not something crazy going on. You got through by yourself, started trading 3 accounts this morning. Okay, so it did approve you and get you into the PA and allowed you to do everything, though. So they're live funded. Very, very nice. See, I told you. You gotta trust me every now and then, Lyle. I'm looking out for you, brother. Man, that's the longest wait ever, isn't it? From the time you pass until the time it actually says PA in front of it. Um, Guys, we're going to check news every morning. We're going to go through and just see what's going on in the wonderful world of news releases. I'm going to tell you right now, I do not trade what they say. So, for example, Tuesday, March 5th, ISM Services PMI. Guys, I don't even know what that is. It doesn't make any sense to me. I know that it's a news release, and I know that investors with deep pockets look for it. That's all I need to know is when there's a high impact or a medium impact. This is a big waving red flag saying, hey, just don't get in. Give it a second. Let it sort out. Don't trade into news. And if you are trading like those Apex accounts or something, they tell you don't trade news. One, because you can blow out quickly, and two, because it's a luck based win, and they're not looking for that. So just so you know, every morning today's Monday, March 4th, and there is nothing going on, whole lot of nothing. Oh, that's weird. They never sent the email, huh? That's crazy. You know, my brother passed a couple Friday in class. They opened up a brand new Apex account and decided they were going to pass it in one day together in the classroom. And he's pending, but they're still not through. So I'm not sure. Maybe they're just a little backed up, little computer glitch. Who knows? Guys, everything that I talk about, you know where it's coming from, right? The tutorial section. For those of you that are newer with me, David H., nice to see you. You guys that are kind of new, the user guide, this is kind of your NinjaTrader how-to, guys. Anything and everything that you could need, whether it is setting up stops and targets, um, opening workspaces, and most importantly, screen capture programs, how to share pictures in class. I will encourage each and every one of you, if you're not comfortable with this yet, talk to me. Let's get you through it today. Let's get you to where you can post pictures today. I'm sorry to hear that, Lyle. You know, word on the street is there's about to be a new funding company, and their customer service is probably going to be outstanding. Just throwing it out there. Hopefully soon. Hopefully soon. Dotting I's and crossing T's right now. Posting pictures. I am too. I can't wait to be a part of it. It's going to be a good time. Um, Ditch you guys. No, I'm just kidding. You guys will still be stuck with me. Um, Guys, posting pictures. Man, you've got to post pictures. That's the easiest way to get to where you want to be, I promise. Um, and then everything that we talk about, all the rules, the looks of the rules, the patterns that repeat themselves. Guys, all of this stuff happens in the tutorial section. Good morning, Joel. And there really aren't any secrets with us, guys. We don't go, hey, let's give them a little and then we'll sell them some more, right? It's just not like that. We try to give you anything and everything that you need. And then more importantly, we try to teach you how to study it so that you can be comfortable with everything that you're looking at. And that's exactly what this classroom does, guys, is we talk about the looks, we talk about how to study it, we talk about how to practice it, how to simulate it, how to get feedback on everything that you're learning. And that's really what this classroom is designed for. So, absolutely. Rob, you have no idea how much happiness it brings me to have this job. I love what I do. It's so much fun. And I actually started teaching my oldest. We're starting with very basic looks. He's getting the exact same rigmarole that you guys get. So we'll see what happens there. But guys, the things that we're going to help you master, Nexgen's going to help you master. And I say we because it's not just me. I've got the microphone in the room, but we've got an outstanding group of sales. We've got the tech that is the absolute best in the business. So Nexgen is always a team effort, guys. But I'm going to teach you a little bit of chart reading. 90% of your day, every day is going to be chart reading. 90% of your day is going to be waiting for advantages. And when they're present, you're just going to hop on them like a kitten on a ball of yarn. And your chart reading is going to allow you to understand three very key concepts, guys. You're going to understand where the market is likely to continue. We're going to use that entry for a high probability trend trade. You are going to pinpoint with pretty crazy, awesome accuracy where the market is most likely to continue. You're going to use that spot for entries. And it's going to allow you to get the most out of these trades. You're also going to understand where the market is likely to go. This is going to allow you to take profits at an appropriate spot. And you're going to learn to trust these Fibonacci areas. You're going to learn to trust momentum to get you there. And you're going to learn to trust that sometimes taking profits at these likely to go spots is your best option. And then finally, you're going to understand where the market is likely to stop. And this does a couple things for the Nexgen users. The first thing it does is it keeps you from taking that last trade that just gets run over, right? These likely to stop areas are what we call termination conditions, and a termination condition can stop a market cold in its tracks. So you're going to be able to identify those before the market ever reaches them. These termination conditions, these likely to stop areas, once they have stopped the market, if they reverse it, it's going to set you up for the highest probability trend trade that you can take. And that's what we talk about extensively in this first hour. And it is the trade entry precision. Good morning, JW. That we talk about in the first hour. I really focus heavily on just figuring out when to get into the market, when and where to get into the market to give you the highest advantage. And then the marathon of becoming a day trader is the trade management. And the more repetitions that you get, the more times you see something, the easier management becomes. But that's really the second piece of the puzzle. So we're going to focus heavily on entries initially. And then, like the broken record that I am, I'm going to remind you that the fastest way to get to where you want to be, guys, everybody came to us saying, hey, I want to be a day trader, right? I want to be a day trader. I want to be a day trader. Well, guys, I'm giving you the recipe to get there quickly, confidently. And it starts with posting trades in the class, guys. Everything you do, and maybe not even just trades, post pictures. If you look at your chart and you're like, hey, Mark, the hell is this red line? Post it in the room. Circle that red line and say, Mark, let's talk about this red line. Let's talk about, whoa, sorry about that. Man, I am so sorry about that. I just rolled my mouse and it was crazy. There we go. We're going to talk about what do these trigger lines mean? What does that magenta line mean, guys? Keep posting pictures in the room. Everything that you see, everything that you do. Let's talk about it. It's like getting a private session. It's like having me one-on-one, and I will focus on whatever you have posted in the room. And then the cool thing about it, though, is the other 19 of you in here get a little lesson off of it as well. So post your trades. Get comfortable posting your trades. If you've never posted in my room, post something today. It can be a picture of your dog. It doesn't matter to me. Just let me know that you can do it. And then the second thing is use that spreadsheet that Nexgen gave you, guys. It is in the Nexgen Study Picks folder. Like I do every morning, I'm going to give it to you right here. You can download it straight from the room and just steal mine. But the first page of your spreadsheet, guys, this is your trade journal. This is where every time you take a trade, you're going to drop it in here. It's going to ask you how you felt, where it was coming from, what were the conditions. You're going to talk about whether you won or lost, and there's even these cool little drop-down menus to make it happen. And then there's a giant notes section. So every time you post in the room, you're going to get some feedback. Maybe the feedback will be, you did everything wonderful. And if that's the case, well, then you want to go to your favorite looks tab and make sure that that picture gets in there because you're going to start building your own plan based on the looks that are bringing you success. Maybe it says, don't trade into termination conditions. You drop this picture in the room and and we talk about it, we say, well, this was an area likely to stop the market, and that probably contributed to you getting run over. Drop that in the room, guys, or drop that into the feedback section. And then what you're going to do every morning is you're going to go back and study the spreadsheet. You're going to study whatever you did yesterday, what you did well, what maybe you didn't do as well as you'd like. You're going to ask yourself what worked and what didn't work, what felt easy, what felt forced. And if you answer these questions, this brief historical study each morning, it's going to prepare you for the day. It's going to get you focused on the advantages and also focused on omitting the disadvantages. This will accelerate the learning, guys. It's done it for everybody that's ever used a spreadsheet. So don't be shy with the spreadsheet. Make sure that you're taking care of it. And then also make sure that you're annotating your charts. Make sure that you're writing enough information on there so that when you come back and study it, you know what you were thinking. We're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. We're going to discuss a high probability trend trade. This is a trade that typically wins 70 to 80% of the time, but more importantly, guys, this is a trade that will teach you to read your indicators. This is going to make you a chart reader. And once you're a chart reader, really the sky's the limit. You will be absolutely floored at what you recognize in the market once you get comfortable reading your indicators. I want you guys simulating. There should be zero fear of failure in the learning process. Failure is what makes the mind stronger. Failure is it's a catalyst for change. I want you to embrace the trades that you lose, but I want you to analyze them. I want you to submit them for feedback so that we can work together to get you through that process. Man, I keep doing this. The idea is that you don't practice the wrong trades. All too often I see people, they're like, I'm just going to get lucky and I'm going to make $1 million on simulator. And they're not really focusing on rules. They're not focusing on advantages. They're not focusing on patterns. And what happens is they get this false sense of security and they jump into the market live and then they just really get their butts handed to them. And it sets them up for long-term failure. And I want you guys to not have to do that. So we're going to simplify. I'm going to give you a rock solid plan called the KISS plan, the Keep It Simple Sunshine plan. And it's going to have two trades. It's going to have this high probability trend trade, the one that we're going to talk about for the next hour. And then it's also going to have what we call a 50-50 trade. And it's a medium probability trade. And a medium probability trade means, let's go to the glossary of common terms because we've got it. We might as well use it, right? A high probability trade, the one that we're going to talk about first, is a trade when each indicator on every chart agrees for the trade. Guys, everything is the strongest. There's nothing in the way. Life is good. It's nothing but sunshine and rainbows. And then your second trade is going to be a medium probability trade. And this is going to be when most indicators line up for a trade. However, a small issue exists. Your ability to read charts that you're going to obtain from learning the high probability trend trade will have you identifying what these issues are. And this really will be most of your trades. You're going to be catching medium probability trades probably more than high probability trend trades, but your chart reading is going to allow you to manage them assertively. Your chart reading is going to allow you to identify the trouble in your way, and your chart reading is going to let you know when it's appropriate to get to a zero loss level. So we're going to focus on the high probability. You're going to incorporate a medium probability, and then you're just going to rinse and repeat. You're going to practice. You're going to take a bunch of pictures. And the more pictures you take, the more you'll understand what looks you're going to commit to. You've got to learn what they look like when they're not moving. So what does the perfect trade look like? Well, when the market is still, it looks just like this. So what we're going to do is we're going to talk about the advantages that are present. We're going to talk about the looks. Good morning, Grant. We're going to talk about how to identify that amazing entry. And when you look at this picture not moving, you're going to be able to come to the live market and you're going to be able to recognize it quickly when the market is in motion. So that's our goal. Our goal is to just learn a couple of rules. You guys post in the room lots. Last week, towards the end of the week, everybody got really vocal and we had probably some of the best lessons that I've seen in a while. I am recording today, so give me some smart stuff, guys. But remember, post in the room. Tell me what you saw. Tell me why you did what you did. And all we're going to do is we're going to talk about the advantages in place. We're going to talk about the disadvantages that may have been there. And we're just going to work hand in hand to get better. And we're going to start the day with a high probability trend trade. 3 rules. That's it. Each rule provides an advantage. Each advantage put together is the recipe for a trade. And one of the hardest things you'll ever do, but one of the most advantageous approaches to trading is if your rules aren't met, which means your advantages aren't in place, you have to simply say, I'm not going to take a trade. I only trade when my rules are met because my rules provide a statistical advantage. My rules set me up with a trade that has been proven to win more than it loses. And that's what the high probability trend trade does, guys. This is a trade that typically wins 70 to 80% of the time when you follow the rules. This is the trade, here comes the catchphrase, that creates confidence through the memory of success, guys. And what you're going to do is you're going to learn to speak to yourself in terms of advantages. And every time, gotta get my laser pointer thing. Every time you look at your charts, I want you to ask yourself, do I have momentum? Do I have a clear path? Do I have an entry area? And if you're answering yes truthfully, well, then you have a trade. These 3 rules happen on 2 charts. That's it. Guys, there's more charts that you can add. I promise. There's higher time frames. There's range charts. Until you are a confident chart reader, keep it simple. Keep it focused on simplicity. It'll make your life a lot easier. The large chart leads the way. The large chart is a representation, I guess is the best way to put it, of what the people in charge want to have happen. The large chart is the large crowd. It's the people with the money. It's the people that move the market. And the large crowd defines areas, direction. It defines momentum because that's what the people in charge want to have happen. They're going to push the market the direction they want it. They're going to put some momentum behind it. And they're going to react to the key areas on your chart that could be problematic. We use the large chart to give us our first 2 rules. And then we use a small chart because this is the small crowd. These are the people that still have some pretty deep pockets, but not nearly as deep as the collective. And they give us little shoves, little pushbacks. And that's the small chart. That's your entry chart. This is where you are going to learn to identify exactly where the market is likely to continue. So the large chart, broad stroke of a brush, the first bar on the large chart, the most current bar, and these bars are just a representation of price. This is going to define the direction of the market through the background color. It's going to define the momentum of the market using some trigger lines, and it's going to define the areas that are helping and the areas that are hurting. And this broad stroke of a brush just shows the overall opinion of the market. Your first 2 rules are met on the large chart, and when they are, you're going to turn your attention to the small chart. You're going to go to that small crowd, and we're going to take this 1 bar, and your small chart's going to break it into 15 to 30 bars. And by doing so, it allows you to pinpoint exactly where the market is most likely to continue. That entry allows you to reduce your risk. It allows you to increase your profit potential. And your 3rd rule, the 3rd advantage, is simply getting into the market where the market is most likely to continue. So we're going to go through the high probability trend trade today. We're going to talk about 3 rules. We're going to break them down. We're going to look at them. We're going to identify them in the large market. And if you have a notepad in front of you, if you're one of those studious types, I want you to write in big letters. I want you to put, speak to myself in terms of advantages. Do I have momentum? Do I have a clear path? And do I have an entry area? And rule number 1 is momentum. We must have strong trigger lines on the large chart. And strong trigger lines only happen if everything agrees in color. So the first thing we do is we define the direction. Green is up, red is down. How simple is that? Only look for rules to be met going with the direction. Guys, this is going to eliminate a truckload of mistakes that new users typically make. So if the background on your large chart is green, the trend is up. We're only looking for rules to be met for high probability trend trades long. Long means that we buy the market, that we want the market to go up. And if the background is red, we're only looking for rules to be met for high probability trend trades short. Hey, good morning, Roku. And short means that we sell the market, that we want the market to go down. So by identifying the background colors, what it does is it sets you up to identify strong triggers. Because the only way that you can have strong triggers is first, if the trigger color agrees with the background. So if your background is green, your small triggers, these solid lines, and your large triggers, the dashed line, they have to be green as well. And if they're not, rule number one isn't in place. And then to define strength, the small triggers break above and away from the large triggers. I want you to see it. It looks like scissors opening. The separation between the small and the large lets me know that the odds are favorable for the market to continue up. And that odds favorable momentum, guys, this is rule number one. This is the best of the best look. This is the look that carries the market to the next key areas typically. This is the look that breaks key Fibonacci areas. This is the look that's even going to cover some mistakes that the new users make. And in a downtrend, when the background is red, smalls below the large, the space between the two, the scissors are open. This is a market, and the odds are favorable for the market to continue down. Here, where the large triggers are green and flat, but the small triggers are down, not odds favorable momentum. Rule number one isn't met. Eventually, you'll learn how to capitalize on this look, but for now, the best of the best, every color agrees, the separation is there, the market is pushing. And then when the small triggers return to the large, we call this a weakening of the large triggers. And a weakening of the large triggers really means that anything can happen up or down. You have forfeited knowingly, if you see this look, the advantage of momentum. So the life cycle of momentum, guys, when it's the best of the best, this is strong triggers down, we're going to sell a pullback to resistance on that smaller, faster chart. You're not going to see the pullback on the large chart. It's just going to be one bar that typically has a tail. But what we're going to do with this much momentum is we're going to use that smaller, faster chart, that refinement tool, and you guys will be able to pinpoint right where the top of that tail is most likely to happen. And then with both triggers down, when one of the small triggers works its way inside of the large triggers, this is the first sign that momentum is slowing. This is kind of that little heads up. Hey guys, we're losing some giddy up here. You can still take a short trade. You just want to make sure everything agrees. You want to make sure that those other two advantages are in place. And then when the small triggers are down, once both of the triggers are inside of the large triggers, you have a weakening or a slowing of the trend. Even the words suggest that your advantage has gone away. Anything can happen is the term that you're going to hear in class, guys. Anything can happen triggers are just that. That market may retrace a little bit and continue down. It may completely reverse. You can still take shorts, but they're no longer high probability. They fall into that medium probability scenario. And when you get these weak triggers right at Fibonacci support or resistance, this is when the market is most likely to stop. So strength is your best of the best advantage. A little bit of weakness, we can still go if it looks good. And then once they weaken, guys, it's okay to sit on your hands and say, I'm not willing to risk my hard-earned money, not on an anything can happen look. So momentum is going to be the first advantage. Momentum is going to be the one that leads the way. And let's pull up a crude chart real quick. And let's go see if we can identify just a little bit of momentum. There's that large chart. When small triggers are outside of the large triggers, when the gap is wide, guys, this is your best look. And you'll see how it goes straight from area to area with all that strength. As the triggers are coming down, there's one of those pullbacks. And if you just scroll back, whoa, my crude oil has some wonky data going on. Can't scroll back on crude, not yet. And up here, we've got that weakening, and notice that there's a little bit of a pushback. So we're going to be able to recognize, this is the S&P. Strong triggers push the market up, buy a pullback. Strong triggers, buy a pullback. Strong triggers down, sell a pullback. So you're going to be able to go back and circle these tails. Look, I still have some circled from last week. When you have strong triggers and you see these tails, guys, we're not trading these tails, but I want you to start using this as a study tool. When the momentum is the best and you see one of these tails, there was a potential entry. And just look what the market does after the potential entry. Look how the market just runs after the potential entry. So what you're doing is you're learning to trust momentum. You're learning to trust the idea that strong triggers up, buy Fibonacci support on a smaller, faster chart, strong triggers down, sell Fibonacci resistance on a smaller, faster chart, and you're going to piece these all together eventually to create a trade. But once you have momentum, is everybody okay with momentum? You guys good with that? Separation is strength. That's the short term. Separation is strength. We have to make sure that we're not hitting an area. We have to make sure that we're not trading into an area that may stop the market. That's rule number 2. It says termination conditions false. None of those likely to stop areas, because what that does for us is it gives us room to the profit target. And that means that we have a clear path. So we already have momentum and direction. The large chart says up. The background is green. The large chart says momentum. Notice the separation between the two, and I'm on the most current bar here. So now we need to allow the large chart to define areas. So areas on the large chart that may reverse the market based on a comparison of the Fibonacci areas and the triggers is going to be blue Fibonacci support, red Fibonacci resistance, yellow 1-to-1 dots, a cyan divergence low or a magenta divergence high. These are just lines that form when there's a loss of momentum. We'll talk about these more today. We're also going to look for any third divergence in the same price range. And then the large chart mid-band if the large triggers are a full bar away. But here's the picture I wanted to share with you. Guys, these lines on the chart can cause trouble. These lines are where decisions are made by the people that move the market. And these lines, we're going to use the trigger lines, the same ones that establish momentum, and you're going to understand whether the area is likely to stop the market, whether or not it has the potential to break, and you're going to be able to identify when these key areas have broken. And you're going to do that all with trigger line locations. So the beginning of understanding termination conditions is allowing price to reach an area. And when I say price reaches an area, I mean that those dynamic Renko bars, the bars that represent price, they just get to a fib, whether or a mid-band or a yellow 1-to-1 or a divergence high or low line. Here they get to Fibonacci support. You can see where the price bar hits Fibonacci support. The only thing that you have to do is ask yourself, where are my trigger lines? If they remain above support, don't take any more trend trades short on the small chart. Don't look to refine it to get a pullback, because you have reached an area that may stop the market, that likely to stop area. It's not guaranteed. It may just create a bounce and then continue. There may be a huge fight between buyers and sellers at this decision-making point. I've seen them last hours. You don't ever have to be caught in it, because you know that when price reaches and the triggers remain above, you have to sit on your hands and do nothing, because the area is like a brick wall and you're in like a 1984 Yugo. You're not going to survive that crash. When your small triggers get through support, so up here price reaches support, the triggers are above, and everybody goes into a holding pattern. When the small triggers get a couple points below, they really smash through the area. And here's the key. They have odds favorable momentum. Guys, this area has the potential to break, but it's not broken yet. But with all of that strength and all of that momentum and those small triggers already just smashing through, this is a Fibonacci area that has the potential to break. You'll pause and you'll make sure that everything is right on an entry chart. And if it is, you may take an opportunity to go short with the potential to break. This is your first medium probability trade. We actually call this one a 50-50 trade. 50% of your triggers break through, 50% have not. It gives us the potential to break. But we don't consider an area broken until both the small triggers and the large triggers get below the area of support. You can see that it now behaves as resistance. And here's kind of the magic of what we do, guys. Once both triggers break through, the path is clear. And we're coupling it with odds favorable momentum. And there's that tail, there's that pullback where you guys are going to be able to pinpoint on a smaller, faster chart where the market is most likely to continue. Guys, this is what we're focused on for the new user, is understanding that momentum creates a huge advantage for a market that's likely to push in the direction of the trend, that a clear path keeps you on the correct side of the decision making of the people in charge. And then when you pinpoint, when you refine and you catch that entry, all of that momentum in a clear path is what carries you to that next key area. And this is kind of what we're working on right now. If price reaches Fibonacci resistance, all you have to do is ask yourself, where are my trigger lines? If they all remain below the area of resistance, the most advantageous thing to do is to sit on your hands and do absolutely nothing, guys. Keep the powder dry, so to speak. From resistance, I want you to see how it pushes all the way down to support. Pushes all the way in the area of that mid-band. All the triggers remain above. So I can't go short, but I just couldn't go long either. This is where we have to have that realization that's sad for a lot of you, that 90% of your day is going to be spent chart reading, guys. The market doesn't offer a statistical advantage 24/7. We have to be a little patient. We have to wait for it. So from resistance, no long trades. Support, no short trades. And I want you to see this. The large trigger is a full bar away. There was room for an entire dynamic Renko bar to get back to them. This is a huge red flag. Don't go short. Even if you didn't believe in the termination condition, we call this the gap theory. Trigger lines are moving averages, and price loves to return to moving averages. So when the large triggers are a full bar away, it behaves like a vacuum and it sucks price right up to it. And then it hits Fibonacci resistance. And once again, your triggers are below, but they're even weaker this time. Notice that the smalls are below the large. Absolutely no long trades. Weak triggers into an area, the area is more likely to hold. It also reaches this divergence high line. So this divergence high line forms when the market creates a pivot. They come all the way up to this key area, and right about the third bar, some indicators in the background, stuff you don't even have to mess with, says, whoa, there was a loss of momentum. It uses a MACD-BB and a couple different calculations. And when that loss of momentum is true, you're going to see a negative number and a magenta line. All this is a loss of momentum. That's it. Don't give it any more power than the market was losing momentum at that pivot. But when price reaches that divergence high line, remember the recipe for a termination condition. Price reaches the area. The triggers remain below. Now this divergence high line is a termination condition. We call it a pivot stop out. We also hit a second level of resistance. The triggers can't get anything done. And guys, when you get a pivot stop out, it's powerful. When it happens at Fibonacci resistance or support, it's even more powerful. And then I want you to see how your weighting is rewarded. No longs, no shorts, no longs. And this termination gives us that full reversal, guys. That small below the large they're starting to get wide. We go from green to red. Notice that there's separation between the small and large. This lets me know that I have momentum to the downside. I also, if I'm looking at this bar, it hasn't reached Fibonacci support. So I have a termination that creates a reversal. We call that a strong top. This strong top gave me momentum. That's rule number one met. After momentum, I haven't reached the key Fibonacci area yet, so now I have a clear path. Both of my rules are in place, and there's that tail, guys. This is where y'all are pinpointing where the market is most likely to continue. And this high probability trend trade that happens after a termination that reverses the market, guys, this is the one that typically wins 70 to 80% of the time. This is the trade that creates confidence through the memory of success. And this is your reward for being patient, for doing nothing when there's absolutely nothing to do. And then don't get despondent, because there's going to be a day where you're going to find trades within this range. But until you're a chart reader, let's hold out for the best of the best. You'll be glad that you did. Because momentum is awesome. And momentum smashes through the support. Doesn't even hesitate. Doesn't even blink. I don't even see a hint of a pullback. And then it hits these yellow one-to-ones. And while you were excited for the short, maybe a little despondent because you didn't get any entries, you know that when it reaches these one-to-ones and the triggers remain above, your advantage of a clear path is gone. And hopefully all of you choose to do nothing here. You choose to sit on your hands and see what the reaction is going to be. You're going to see if the buyers are going to buy or if the sellers are going to push through. But you know that you're a small fish in a big pond, and there's no reason to jump in the middle of that fight. Saved your bacon this time, because look what the buyers do right off of that termination condition. Huge push all the way into resistance, but all the triggers are below, so we're not going long yet. My trigger lines don't agree, so I don't even have momentum. I'm not going long or short. And the reality is I'm doing nothing for almost 45 minutes, guys. I'm playing a game on my phone, playing a little Scrabble on the computer, calling my wife, telling her she's pretty, scratching the dog behind the ears, and I'm waiting for my advantages to come into play. Well, this termination does reverse the market, so it is a strong bottom. But I can't trade into resistance. Notice mid-band, large triggers a full bar away. There's that gap. I'm not going long yet, but if I'm patient, eventually I do get momentum and all of my triggers are above resistance and it behaves as support. I haven't reached the next area, so I have momentum as well as a clear path. Let's get in right here. Let's buy Fibonacci support with strength and a clear path and ride that momentum to the next key area. This is the 90%. This is the 10% that's going to have you reaching your goals. And the key is to learn how to not give $1,000 away here to make 500 here, if that makes sense. So termination conditions, guys, you're going to see them all day, every day. Termination conditions are going to happen on the large chart. Those lines are going to be the indication that the market may not go up anymore. And look at how it stopped to the tick. Does everybody see it? Price bars came up to Fibonacci resistance. None of the triggers were able to break. And guys, this started our down push right into Fibonacci support. Notice that the large triggers are a full bar away, no short trades, and it closes the gap. And then it continues down. The small triggers break through, giving it the potential to break, but the area didn't break. And it bounces up again. And then when I finally have a clear path and momentum, notice how support became resistance. This looks almost exactly like the user guide. The picture was taken 3 years ago. And that market continues down. And now we're coming into that Fibonacci support. One of the best study tips or tools that you can give yourself is scroll back. Circle a termination condition. And I'm going to show you exactly what the people that get to where they want to be the fastest do. They take a big picture of their large chart, and I want you to see this. I'm going to draw a box, and I'm going to use a call out button. And I'm going to say price reach resistance. Why am I saying that? Because that's the first part of the equation, because price reaching the area sets off the decision making for the people in control. Triggers remained, I'm struggling with my typing, remain below. This is a term, no more longs, rule 2 not met, whatever you need to put, right? Not a clear path. Maybe put all of that, because what you're doing is you're learning to recognize this when there's nothing going on, so that when the market is live, when the market is pushing, you know exactly what it looks like when you reach an area where the market may stop. I want you to also see this: strong triggers, buy a pullback, strong triggers, buy a pullback, strong triggers, buy a pullback. Rule number 1 says the market's likely to continue. Rule number 2 says it has the potential to stop. So what you're going to do is you're going to piece these two together where you have those strong triggers, where you see that pullback, but if it's into a termination condition, you're going to say, not my trade. If the smalls break and the large don't, that's a potential trade. If the smalls break and the large don't, that's also a potential trade. So not every move is going to be your move. Not every opportunity is going to be your opportunity. But if you get to the point where you realize that when you reach an area and none of the triggers break, it's just not an advantage anymore, you feel pretty good about just sitting on your hands and doing nothing. So that's termination conditions. Is everybody good with it? Everybody comfortable with the idea that we're going to let lines on the large chart tell us when that path isn't clear? We're going to let lines on the large chart identify potential trouble. We're going to let lines on the large chart let us know that if the market reverses from it, a no triggers through termination. That's the key. A termination that none of the triggers broke through, guys, reverses the market. That's a strong top and a strong top or a strong bottom here. And that's the precursor to the highest probability trend trade that you can take long. And then if we back it up just one, A strong top, no triggers through termination, is the precursor to the highest probability trend trade short that you could ever take. Sometimes the market turns from nowhere. Remember that this is a loaded down freight train of a chart, guys. It's a slow moving chart. It is molasses in January compared to the small chart. So sometimes it's going to turn, but you're not going to see that change happening. Even with odds favorable momentum, that market may reverse without hitting a key area, and you're not going to see that change on the large chart. So this is the only termination condition that I'm going to use on the small chart, because the way we use lines on the large chart to identify problems, we're going to use lines on the small chart to identify entries. When everything is strong, we're going to sell a pullback to Fibonacci resistance. We're going to use those lines to define where it's most likely to continue. So on a small chart, the only termination condition that we're ever going to use is 3 divergences in the same price range, 3 losses of momentum. Cyan lines with a negative number from a low. And guys, the negative number means nothing. It's a byproduct of the calculations. 3 magenta lines with negative numbers from a high. So you're going to see these 3 divergences in the same price range, and you'll be able to say to yourself, the small chart is showing me change. The small chart is showing me what the large chart can't. So you'll see this from a low or this from a high when your large chart may be changing directions. You'll also be able to recognize if your small triggers work their way inside of the large triggers, if you end up with those anything can happen triggers, it's more likely to reverse the market. It's more likely to give you that big push back. And if that final pivot from a low is higher than the previous or lower than the previous from a high, it becomes more powerful still. It creates this head and shoulders pattern. So 3 divergences in the same price range on the smaller, faster chart is a termination condition. And you're going to use this. Rule number 2 is not met, no more trades. But you'll also use it if you see these divergences print. Maybe you're in the perfect trade and you get a higher divergence than the previous. It's a great exit condition. 3 divergences is a great exit condition. But if they start printing higher, you'll use this as a management tool. If they start printing lower, you'll use this as a management tool. So divergences on the small chart are going to give the indication that the large chart may be changing. 3 divergences on a large chart is like a, hey, look out. This market is really likely to push down lower, and check it out. Boom, 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 Geronimo. Just a little something for you there. All right, termination conditions. They give us room to the profit targets, guys, or a lack thereof. So the large chart, the first bar on the large chart has defined direction. The background is green, the market's going up. I'm only looking for rules to be met for high probability trend trades long. The trigger lines on the large chart have told me that I have momentum. Rule number 1 is in place and I have strong trigger lines. The smalls are above the large, both are wide, both are green, and the space between the two, like scissors open, lets me know that the market is likely to continue in the direction of the trend. The large chart has defined areas through rule number 2. We have not reached Fibonacci resistance, and we have cleared the resistance below us. Rule number 2 is met. I have a clear path. Guys, give me a Y in the room if you're with me. The large chart, 1 bar on the large chart has told me that I have the advantage of momentum as well as a clear path. And because I do, man, it's refinement time, guys. We're going to go to the small chart and we're going to refine that broad stroke of a brush. We are going to pinpoint where the market is likely to continue. So much so that we're going to use a limit order to buy or sell a pullback. That little shove. Hey, good morning, Cav. That little shove that the small crowd gives us, we're going to use that. We're going to buy or sell a pullback at an area. Areas where problems on the large chart, they are bounce points, continuation points on the small chart. We're going to look for Fibonacci support or resistance. We're going to look for yellow 1-to-1s, and we're going to look for mid bands. But here's the key, guys. They need to be in the triggers. Remember, the triggers are where the market corrects to. They're a moving average. You see it all the time. We want to give it something to bounce off of at that correction point. So we're going to use a limit order to buy or sell a pullback on a smaller, faster chart at an area inside of favorable large triggers. And that's rule number 3. That's the advantage of getting in where the market is most likely to continue. So when everything says up, the momentum is the best, everything is there, you're going to be able to identify low. You're going to buy low on that pullback to support. Or when everything says down, you're going to be able to sell high at resistance on that smaller, faster chart. And you're going to do it through the refinement process. 1 bar on the large chart. If I put that box around it, you can see all of the movement on the small chart. Just 1 bar. It says down, it says strength, it says go, go, go. The bottom of the bar, of the most current bar, is where we're going to start the pullback process. The top of the bar, that tail or that wick, for a short trade, should be resistance inside of triggers. So I'm not trading the tails, I'm refining it so we can pinpoint, and the room to my targets increases dramatically by selling high. And the same is true going the other direction, guys. So when everything says up on the large chart, when everything says momentum on the large chart, when the large chart hasn't reached one of those key areas and the path is clear, we're going to wait for a reversal bar on the smaller, faster chart. This reversal bar just signals the beginning of the pullback, that little shove against everything that the large chart says. At the time of the reversal bar, the first thing we're going to do is we're going to look for our correction spots. Those are the trigger lines. Large triggers are smooth, synthetic triggers are stepped. The synthetic triggers, synthetic for Nexgen users, means from a different time frame. Your large triggers on the large chart are transposed, I guess, over to the smaller, faster chart, and you see them as synthetics. When your large triggers and your synthetic triggers are one on top of the other, tight in the same direction and wide, we call this favorable large triggers, because what it does is it gives you the least amount of space for those lines to be in there. Remember that we're not trading from triggers. Our rules say that we are going to buy or sell a pullback at an area, fibs, midbands, yellow 1-to-1s, inside of the triggers. So price corrects to the triggers, and then it's like throwing a tennis ball against a brick wall. We give them something to bounce off of. So the reversal bar starts the pullback. You identify your trigger lines, and then you look for the areas inside, fibs, midbands, yellow 1-to-1s, for a long trade. Your window of opportunity, the point where the market is most likely to continue, goes from your highest point of support inside of favorable large triggers to your lowest point of support inside of favorable large triggers. This cyan box, this light blue box, represents the point where the market is most likely to continue. And you'll see that it's not one tick, right? It's a window. It's a window of opportunity. This Fibonacci support is outside of the trigger lines. It's outside of the correction point, which means that it's not a part of the window. If price gets down here, we don't want to be in that trade anymore. And then for a short trade, it's the exact same thing, the opposite direction. The rules don't change long or short. The looks just get inverted. So a reversal bar, the one green bar after all the short bars, says, hey, guess what? Here comes the pullback. You guys are going to look for your triggers, large and synthetic. In a perfect world, they're one on top of the other. Guys, the more they are spread apart from one another, the larger your window becomes. And the larger your window becomes, the more risk you're going to have on a trade. So we find the triggers and we look for the areas inside. And this is one of those magical moments where there's only one. I have a midband running right down the center. This is where the market is most likely to continue. I'm going to activate my limit order a tick or two below the lowest point of resistance, and I'm just going to wait. And if the small crowd can push it back, I'm in that short trade right at the bounce point, guys. And if the small crowd can push it back, I'm in just a couple ticks above that highest point of support. And this is your entry. This is what we're looking for 20 days for the new users. We're looking for momentum. That starts everything. Trading with the trend, trading with momentum. We're looking for that most current bar. Has it reached an area? Not yet. Man, it's close though, isn't it? How can I make any money if that large bar, if that first bar is 5 ticks south of a divergence high? Well, because you wait for the pullback to the area inside of favorable large triggers, that $50 profit turns into $250 worth of potential, guys. Buying the pullback also allows you to reduce risk. It increases profit potential. And what it does is this shows that two chart process. Large chart says up, large chart has momentum, large chart hasn't reached the key areas. Small chart lets me break that one bar into 15 to 30 bars. I enter its support inside of favorable large triggers and off it goes to my target. One more look, momentum, clear path, wait for the pullback, identify the areas, get in where the market is most likely to continue, and in a perfect world, get out at that next key area where the market has the potential to stop. And guys, it's the same thing every day. The same patterns every day because they provide a statistical advantage. And that's your entries. Are there any questions about a high probability trend trade entry? Momentum means separation, means strong triggers. That's it. Strong triggers lead the way. Strong triggers break areas. Strong triggers should set the tone for everything that you do. I'm going to tell you right now, guys, go back on your large chart, circle tails with strong triggers and see how many times they continue pushing. You're developing trust as a brand new user in this idea. A clear path means that there's nothing for this chart to bounce off of. And with all that momentum, it's literally like a 20-ton semi, or I don't know how much they really weigh, going down the highway at 80 miles an hour, and it just can't stop. It's just hard to slow it down. But the small crowd tries, and they give it a little push, but usually this look continues up. So we give it a bounce point and off we go. And one of the advantages of knowing where the market is likely to continue is you also know where it shouldn't go outside of that window of opportunity. If my lowest point of resistance to my highest point of resistance inside of triggers is here, this is where I anticipate the market to continue. So I'm going to put a stop 4 or 5 ticks above all those trigger lines. And I'm going to say to myself, if the market continues beyond this window of opportunity, if it pushes beyond these trigger lines, I'm out of the trade. That's not working the way it's supposed to work. Anything that wins 70 to 80% of the time has to lose 20 to 30% of the time. And one of the things that you're going to realize as a day trader is that losses are a normal part of a positive equity curve. It's very rare. It's very rare to have 100% winners. So Rob, it's not even that a fib is needed to reverse. The reality is the market can reverse from anywhere at any time. We're not in control. Somebody with deep pockets, everything can be going up. Momentum can be its absolute strongest. There can be absolutely nothing in the way, and this jerk face with $1 billion account sells, and it just turns, right? That happens sometimes, and there's nothing we can do about it. We're not in control. So what we're doing on the entries, Norbert, is we're saying, all right, the guy in charge says it's going down. The guy in charge says there's nothing in the way. So the pattern that has been proven through historical study, the pattern that has been proven through the pictures that you take, through the simulation that you do, the pattern that has shown me that it wins more than it loses when the conditions are right, is entering at a bounce point inside of triggers, right? So what helps, Rob, is triggers are awesome, and you'll see it bounce off of triggers all the time. But the real advantage, the best of the best, comes from giving it a bounce point, right? If you and your little brother are playing football, if you throw it over his head, he's not going to catch it. But if you throw it into his head, it's likely to bounce back at you. So this gives you a bounce point, and it allows you to define your risk. These little fluctuations happen all day long. You can literally, with the right entry, find yourself with 3 or 4 ticks risk on a trade. Market pulls down, you enter at the area inside, you get a reversal bar in the direction, so you minimize your risk below it. And then it turns out that the dude with money wants it to go down, right? You give up $30 instead of $300. You give up $40 instead of $250. And guys, this is one of the keys, is losing less than you win, right? So I know traders that I've had days where I've won 35, 40% of my trades. and still come out goals met, because I'm losing 30 or $40 a contract because I'm in at the right spot because I'm waiting for the pullback, but I'm winning $200 to $300 a shot. And that's really where the balance comes in, is being able to identify where the market is likely to continue, being able to understand where the market is most likely to reverse, to bounce, and then just putting that together and saying, all right, let's make it happen. That's the NASDAQ doing a lot of bouncing in there. And then crude oil, once again, momentum, right? It turned from nowhere. But weak triggers gave us a great indication that anything could happen. So without the strength, right, with ugly triggers and my areas beyond it, nobody went long up here. And then when it turned around, some of you know how to catch that one, to push down. And here it pulls back a little bit, but there's a big gap between the triggers. So we're waiting for it to all come together right now. We're waiting for everything to come together to give us the best chance of success. Guys, learning to find these advantages isn't difficult. It really isn't. It takes a little bit of time. It takes a little bit of practice. But the path has been the same. The path is consistent. And I want you to approach this like you're a kindergartner, right? So day one in kindergarten, you're not talking calculus. Let's just understand which way the market is moving, right? The first step is to understand whether the market is going up or down. Is there anyone in the room that's not good with that? Green is up, red is down. I mean, how simple can it be? I don't know how to make that any easier. If, and this is where the if then, this is the rules process. If the market is green, or the background is green, then my look is smalls above the large are wide, the space between. This lets me know that I have momentum, and that's really it. Up, this is my look. Down, this is my look. It doesn't change. Momentum should be consistent 100%. Buy a pullback, sell a pullback. Once I have momentum, I have to make sure that it hasn't reached an area. That's it. So I'm going to start studying up and down. Done. 8 seconds. Then I'm going to go back and I'm going to find 20 pictures. Excuse me. 20 pictures of strong triggers. 20 pictures of strong triggers with a tail. Why am I doing that? I'm doing that because I'm developing trust. I'm developing trust in the idea that strength in the trigger lines, I forgot my crude oil is messed up. I'll try to reload that in a little bit. That strength in the trigger lines sets me up for success. That strength in the trigger lines gives me the best of the best look. So go back and circle 20 of them, right? Circle 20 of them. That was at 10:10 on Friday morning. And then once you do that, once you have momentum, once you have a clear path, I want you to see what happens when I go back to 10:26 on Friday. If it pulls back to an area of support right at the triggers, guess what? You just found a high probability trend trade without having to be in the live market. You just found a high probability trend trade without the anxiety of being in a trade. So your job as a brand new user isn't to get in the live market every second of every day, but go back and draw an arrow. And I want you to get in the habit of writing the rules. This is strong triggers. And what does strong triggers do for me? It gives me momentum. And that's all I'm doing is I'm associating the look with the advantage. And then I'm going to draw another arrow to the top of that bar that had the tail. And I'm going to put price had not reached an area. My path is clear. And that's rule number 2. And then in the same breath, I'm going to put buy a pullback at an area inside of triggers, because that's the recipe. And what I've done here is I've said that this is my best look for momentum. This is my best look for a clear path. And this is the most advantageous spot to enter the market on a pullback. So I take this picture and I share the link to screencast, guys, and I come over here to my spreadsheet and I go to my favorite looks and I'm going to drop it in there. I'm going to drop that screencast link in here. And the link is kind of ugly, right? It's just screencast.com, blah, 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 blah. So I'm going to go to the Insert tab and the link button, and I'm going to change this ugly text to display to something a little more manageable. The link goes to the address bar like it was going to Google or eBay. And I'm going to put my perfect long, and I'm going to own that look. That's going to be my perfect long. So when I come back tomorrow morning and I'm wondering what it's going to take to get me in the market long, it's going to take strong triggers, a clear path, and a pullback to an area inside of favorable large triggers. And I'm telling you guys right now, this is how you get to where you want to be. 15 pictures a day, guys, is 300 pictures a month. I typically take 15 pictures before I ever get to this classroom. And I think that everybody wants to be in a trade. Everybody wants to find a trade. What I want you searching for initially is I want you searching for strong triggers. And I want you searching for those tails, and I want you to burn this look in your mind because this is the best of the best look. And then once you burn that look in your mind, I want you to start looking for termination conditions, and I want you to scroll back, and there's three possibilities. The three possibilities are, open up. Price reaches an area, no triggers, the path isn't clear. The small smash through with odds favorable momentum, it has potential. Small and larger through, the path is clear. And guys, these are your options. So you're going to go through on your large chart once again, and you're going to do that study. Let's go back to the large chart. Oh my gosh, so much stuff. And you're going to say, price reached Fibonacci resistance. All of my triggers are below. This is a termination condition. Rule number 2 isn't met. Therefore, I'm not going to take the trade. And I promise you, if you allow it to be that simple, it really can be that simple. So that is the first hour, guys. It's 9:59 a.m. That's the first hour. It's the same hour that it has been every day for the last 3 years. It's the same hour that we talk about each and every day. And it's nothing more than setting you up for success, guys. It is learning the Fibonacci rules and the trigger lines for when it's okay to trade. And I'm going to tell you right now, if you're brand new, if you're sitting in the shadows, if you're hoping to absorb this through video, I want you asking questions. I really want you, even if you're too scared to post a trade in the class, I still want you asking questions. I want you simulating. Practice, 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 practice. Simulation will become easier the more pictures that you take. The easier it becomes, the more pictures you take. And then when you see 300 pictures, that's the third tab, where I put all the work in, guys. 300 pictures that I stole from you guys. Here's Joel's perfect trend trade long. And it's got momentum and a clear path, and it hasn't reached the area. And Joel got in at the area inside of favorable large triggers, and he got paid all the way up. You can go back and study other people's trades and look at those advantages and just really burn it to memory. And I had someone tell me once, they go, Marco, you make it look so easy when you read charts. Guys, I'm reading charts that aren't doing anything. I've got no fear of a loss. I've got no anxiety because I have no money on risk. This has already happened. This is easy, right? This is like learning about history so you're not doomed to repeat it. So I want you guys to focus heavily on talking to yourself in terms of advantages. Every time you take a trade, talk to yourself about advantages. Talk to yourself about whether or not it's coming from a termination that reversed the market. Talk about strong triggers. Talk about termination conditions. Talk about the area inside of favorable large triggers. And if you can mark yes to each and every one of these on the checklist, you have a high probability trend trade. This is a trade that typically wins 70 to 80% of the time. I've never had anybody use this checklist and do worse than 70%. Let me give you the checklist. Print it out, put it on your desktop. But right now what I'm doing is I'm giving you a plan, guys. I'm giving you something to focus on as a brand new user. And this plan is going to make you a chart reader. This plan is a stepping stone in your learning journey. So Grant, this is the beginning for you, right? This is you just becoming a chart reader, keeping it simple, keeping it focused. Arnie, this is keeping you from chasing everything, but rather looking for the absolute best. And it's designed to optimize your chances of success as a new user with the high probability trend trade and the 50-50. So Arnie, the 50-50, great question. Thank you for that. I'm going to show you exactly what a 50-50 is. When the small triggers smash through the area, but the large triggers haven't, 50% of your triggers have broken, 50% have not. And that's all it means. It means that the area has the potential to break based on momentum, but until it actually breaks, it still has the potential to push up. It still has the potential to reverse. So 50-50, well, no, you have a strong trend, watch this. Strong trend is a fallacy. Trend just means that it's going up or down. Does that make sense? If I take everything off and all you have on this chart, let me do it real quick. Up, down, up, down, up, down, up. That's it. That's just a trend. There is no strength in a trend. But what there is strength in is there's momentum within the trend. And that's rule number one. So we're not confirming a strong trend. We're going to confirm strength through the trigger lines. We're going to validate and verify a clear path through trigger line location. So even with strength, if we reach an area and the triggers don't break, we're not going long into that area. Does that make sense? Even with odds favorable momentum, if price reaches Fibonacci support and the triggers don't break, I'm not defining a strong trend. I'm defining strength in the move. And then the trigger lines help me determine whether or not my path is clear. Does that make sense? I think it may just be a little verbiage thing. When I say strong trend, when somebody says strong trend, what it does to me is it makes me feel as though they feel like the trend should continue, even though the termination condition is in the way. So I want you to not think about trends as strong. I want you to think about the move, the current move is strong. And when the current move is strong and you haven't reached the next area, we'll sell a pullback. And then when price reaches the area, we'll sit on our hands or take profits. When the small triggers break through the area, this strength has the potential to break the key area. But if it reaches another one before there's an opportunity, I still have to sit on my hands. Does that make sense? And that's kind of how termination conditions work. They have the potential to break, but until both triggers get through, it doesn't guarantee anything. So I don't know if the trend is strong. The move within the trend can be strong, maybe. And then Rob, yeah, you can have strong triggers, you can have weak triggers. So it kind of is. It's a medium probability trade. My little slide rule here. So these are your advantages, right? Momentum, clear path, and an entry area. And Arnie, thank you for being vocal. This is how people get better. It really is. So momentum is defined with the strong triggers, right? It's that immediate momentum. A large crowd says go. When terminations are false, that means that both triggers are on the other side, that we haven't reached another area. But the 50-50, Arnie, what it does is it takes away our clear path. Not always problematic, but it's just going to the potential to break rather than actually broken. Let me pull up a picture. And I love this because this is one of the most lost trades out there. And I'm not trying to scare you guys with that. but it's got potential because strong triggers can break areas. So I love this look, and you guys will take a lot of these looks. There's no doubt in my mind. But if we go back to my little slide rule thing, because the clear path isn't present, all it does, Arnie, is it puts on that management hat. Is it has you saying to yourself, I'm not going to give up momentum and I'm going to make sure that I have a great area because I'm not willing to have the potential to break and no momentum because then I'm just relying on an area. Or if all I have is momentum but no clear path, then I'm just relying on momentum to take me to that next area. And as you can see right here, that momentum wasn't able to do it, right? As you come down with all the momentum in the world, that clear path kind of stopped the party. So I always think to myself in terms of never give up more than 33% of your advantages. And that puts you in that medium probability scenario. And this is going to show you how to take that 50-50 trade with the highest chance of success because I want you guys to stay busy because idle hands and the devil's work and all that good stuff, right? So this plan is going to optimize your chances of success with a high probability trend trade in the 50-50. And then as you guys study, as you simulate, as you get a lot of class feedback, in continuous practice, you're going to create your own plan. Your chart reading, your experience reading the indicators is going to have you creating a plan where you're going to start catching those momentum trades that you see. You're even going to find ways to catch like continuation of a trend, even fighting what the trend is. And it's chart reading that's going to take you next level. But if you focus on simplicity first, you're going to get to that level faster. So never fight the large chart initially as a brand new user. Don't fight the large chart. Use your high probability trend trade checklist. I dropped one in the room for you and get into the market at the right spot. And that's the most important thing you can do. Because when you get in at the right spot, when you identify where it's most likely to continue, you know exactly where to put your stops. So the way your entries are very mechanical, your management should be too in the beginning because we're still learning to read charts. We're still learning to understand change in the market. We're still learning how to look at our indicators and really discern that information in a second or two. And you'll get there, repetition. But your management can be just as mechanical as your entries for the new user because it takes that emotion out, it takes that opinion out, and if you really commit to the mechanical process, it's only if then. If you enter at the best of the best spot, and that's what this management plan is designed on. If it's a high probability trend trade, if you get in at the best spot, your stop has to go where the market shouldn't, 4 or 5 ticks above that highest point of resistance inside of triggers. And if it hits your initial stop, guys, that's it, you're out. It's a cost of doing business. It's literally like paying rent. And you will lose trades. I promise you, you will lose trades. But with momentum and a clear path and the perfect entry, more often than not, you should get a reversal bar in the direction of your trade. And what this does is it allows you to reduce your risk, to go from outside of the window of opportunity. You're saying to yourself, the market's doing what it's supposed to do. It's going with momentum. It's going with the clear path. I'm going to reduce my risk 2 ticks above it. And then once you reduce your risk, once again, there's nothing for you to do. Put your hands in the air, roll back from the screen, and let it play out. And it's either going to get you on a smaller loss, which is cool. You'll literally learn to not sweat losses at all. But with all the momentum in the clear path, it's more likely to hit your first target. And I've put your first target out there at $100. And $100 isn't a lot of money, and $100 isn't going to buy you that new Ferrari. But $100 is going to create confidence through the memory of success. $100 is going to make you feel good about trusting momentum. It's going to make you feel great about pinpointing your entries. $100, guys, this is going to be the most important $100 in your trading career because it's going to get you to the point to where you begin to trust. You begin to trust the methodology. You begin to trust the advantages. And then you're also going to go to break even, which is ridiculous. It's chum in the waters. I'm going to tell you right now. A break even stop is going to get hit more often than it doesn't. And you're going to be out of that trade for $100. But I want you to keep that stop break even. Give me 30 days on it. Because what it does more than anything is it reminds you that the only reason that you took this trade in the first place is because the large chart said that the market was more likely to go down, because the large chart said there's nothing in the way to create a bounce. The large chart said, hey, Arnie, we are dropping out of bed, brother. And if you got an entry, we still want to drop. So you're break even, you've got money in the bank, and it becomes easy to trust the large chart. And your second target's only $200 in the distance. And once again, guys, this is a short-sighted figure. It's $200 is not a lot of movement when there's that much momentum and a clear path. But by hitting that $200 target, you're out with 300 bucks, guys. And $300, man, that's a pretty good trade. Nobody would be upset if I said, hey, give me your cell number. I'm going to Zelle you $300 real quick. You'd be like, hell yeah, $300, right? And you're going to get out and you're not going to do anything else and you're just going to wait for the next trade. $300 richer. But let's go back to the KISS plan. You will craft a plan tailored on your personal goals based on your experience reading the indicators. So what happens is you begin to trust the entries. And that's all I want right now, is for you to trust the entries. And once you trust the entries, you're going to begin to recognize that with this much momentum and a clear path, those $300 trades are starting to turn into $400, $500, $600 trades. You're going to find that with this perfect entry, you'll start making more money on the exact same trade. You'll maybe add contracts on the exact same trade. And you're going to put yourself in a position where you can really get more out of these trades. And here's one that was presented in class. This is the second half, guys. This person had momentum and a clear path, and they took the perfect entry and they exited at the divergence low. And I said, wow, what a great trade. What a beautiful trade. What a great moneymaker. But the management lesson came in by presenting in class. We had this great conversation that with a clear path and this much momentum, there's no reason to exit so soon, right? If you're trading two contracts, maybe one off, but this is where the runners come in, guys. And this is where you really capitalize on your very basic lessons. You capitalize on understanding that momentum is likely to push the market in the direction of the trend. You understand that nothing in the way means that there's no bounce point. It's more likely to get to that next key area. And then once you've refined the entry, it's so easy to get to break even at the first trouble spot. It's so easy to really learn to trust that momentum. And that's what we're doing, is crafting a plan based on your ability to read the indicators. And until you can do that, keep it simple. And then Arnie, as we go into the 50-50 trade, the first thing that I tell you guys is one area not broken, because the more areas that have to break, the more difficult it becomes. Just because it's a lot of work. And if decisions are made at areas, the more areas that aren't broken, the more decision places there are that you have to fight. You must have strong triggers on the 5-1, the exact same strong trigger look on the large chart. Because the path isn't clear, I'm not giving up momentum. On the large chart, I'm not giving up momentum on the small chart. And then this one is really key. No divergence on the 5-1. Because what is divergence? Does everybody remember? Divergence is a loss of momentum. And if I'm already giving up a clear path, does it make sense to give up momentum as well, even on a small chart? And then coming from a good top or bottom, meaning that a no triggers through termination reversed the market. Why am I looking for a good top or bottom? Because it means that decisions were made right at a key area, that the buyers couldn't get anything else done, that the sellers said, hey, guess what? We're taking over and this is our party now. So when I have a great top or bottom, it increases the likelihood of success. And then we're just going to use our entry rules from the high probability trend trade. And then it reminds you, divergence, no trade. Why is that? Because my new users that take these 50-50 trades lose against divergence more than they win. And when you lose more than you win, guys, you start to get dejected. You start to get frustrated. And when you get frustrated, you either quit because, I'm so frustrated, or you start breaking your rules to make up, to try to eliminate that frustration. I can get it back one good trade. So keeping it really focused on these trades initially, you will change your plan on the 50-50s. And here's one of the things, guys. Management's the second piece of any puzzle. Management is the second part of any trade. If you get in, you have to know what kind of trade you're taking. And I see this mistake a lot. If you take a high probability trend trade, this is the easiest to manage because everything is perfect. If you take the medium probability 50-50, well, then you're still going to use that window of opportunity for stops. You're still going to use a reversal bar. But you have to manage differently. If a divergence prints, you're going to exit the trade. You're going to get out. You're not going to hope anymore. You're not going to sacrifice advantages. You're still going to have quick profits. Notice that it says $100 or the first trouble spot. Guys, if your first trouble spot is $80 away, then $80 is your first profit target. And you're getting to break even because you don't know if it's going to break. And then quick profits on the second, guys. So I'm going to give you the KISS plan here. I can't make you follow it. I can't force you to trade it. But I can tell you that I've seen a lot of people obtain a lot of success with the KISS plan. I've seen a lot of brand new users get funded on these prop firms in their first 30 days. And if you're a more experienced user and maybe you're coming back, maybe you're struggling a little bit, maybe you're not getting the consistency that you want, the challenge that I always put before people, and I've done it a lot, is give me 5 days on the KISS plan. And there's going to be a couple things that happen. The first thing is you're going to have this plan and you're going to be at about 55-60% winners and making money. And you're going to be like, oh my gosh, I have to stop chasing everything. I only have to chase the best. Or the other thing that's going to happen is you're going to follow the KISS plan for about 8 minutes. And then you're going to get bored. And then you're going to break your rules, and then you're going to lose, and you're going to get mad, and you're going to curse my name, and you're going to curse Nexgen software, and you're going to curse everything, the market, the people in charge, the dog barking next door, the guy across the street mowing his lawn. It's going to be everybody's fault but yours. But the reality is traders lose when they break the rules. Traders lose when they stray from a statistical advantage. Traders lose when they impart their emotion over their analysis. And Bob, you're in that struggle spot. And it's okay to be in that struggle spot, guys. It really is. Everybody's going to be in that struggle spot. So Bob, I'm going to put you on the spot for just a second. And I'm going to tell you guys right now. So this whole plan came to be because the gentleman called me, and Bob, he may have been in the same boat that you were in. And this is exactly how it went. I'm just going to give you the whole conversation. Hey, Mark, I can't find a trade. And that's exactly what I hear. Hey, Mark, I can't find a trade. And I always ask, I say, well, what kind of trades are you looking for? Well, I'm looking for a trend trade, and I'm looking for a momentum trade, and I'm looking for a 50-50 trade, and I'm looking for an HVA trade, and I have this trade that trades the gap theory, and then I'm looking for a counter trade. And I'm not going to lie, guys, my response is always, holy shit, you're looking for everything. You're trying to be a part of every move of the market. And what happens is they tell me, I can't find a trade. Despite having 6 different trades they're looking for, they can't find a trade. And let me show you what happens. This is their trend trade rules, right? And so I'm looking for a trend trade rule, but I'm confusing it with my momentum trades, but it's got a little 50-50 and a VA in there and a gap counter. And they're taking 6 different trades and 6 sets of rules and 4 different charts. And what they're doing is they're creating this bastard love child of the 6. Does that sound familiar to anybody? Have you ever taken a trade and said, oh my gosh, I just put 2 trade rules together and lost this trade? Man, I've done it. Guys, this class is developed around my shortcomings, I promise. So how do we fix that? How do you fix that? And I'm going to give you the secret right now, guys. Is simplify. Simplify, simplify, simplify. Every trade is a momentum trade. Just simplify. Just take the burden of finding everything off of you. And it's a little boring. It's a little boring to do it. But I'm going to tell you right now, I had somebody call me one day and he did that. He goes, Mark, I'm looking for everything and I'm finding absolutely nothing. And that's how the KISS plan came to be. And then I also had somebody call me one day and essentially accused me and Nexgen of being absolutely full of crap. You guys are snake oil salesmen. You're horrible people. You're preying on people. And I think that there's probably a place in hell for you, essentially, is what he told me. And I said, all right. I said, let's get it out. Why? And he goes, because all of these trades that you say happen every day, they don't happen at all. They never happen. To which I replied, okay. I said, do me a favor. And guys, it all comes back to this. Do me a favor. Send me your last 10 trades. And let's just look at them together, because what he didn't do is he never posted in class. He tried to learn the software on his own at home through videos and never getting feedback. And it turns out that he was just misunderstanding a couple of the advantages. He was misunderstanding a few of the rules, mostly the terminations. So he sent me 10 trades and I marked them up and I used the checklist. And I said, okay, here's where you went wrong. Here's where we had challenges. Here's where it didn't work out. And I said to him, and I gave him the challenge. I said, do me a favor. Your chart reading is unbelievable. So Bob, I would wager to say that your chart reading is pretty good, right? You're comfortable with the advantages. You're comfortable with momentum. You understand a termination condition probably. Yeah, for sure. There's no doubt in my mind. So Bob, 5 days on the KISS plan. And what this gentleman did is he came back to me, and it was about 7 days later, and he said, respectfully, I was wrong and I'm sorry. And I didn't mean to accuse you guys of this stuff. And he goes, what it turns out is I wasn't actually trading rules. I was just looking for trades. I wasn't looking for advantages. And when he followed the KISS plan, 7 days, and guys, it's rare that people can really stick to the rules that well when they're frustrated, so it might take a little bit. But he came back at 70 plus winners, and he's trading professionally every day. That's what he does. He supports his family with it. But every trade that he didn't believe were happening were because he was looking for the wrong stuff. He wasn't looking for the advantages. So I'll say without hesitation, I'll say without question, what we do works, guys. What Nexgen teaches is, in my opinion, the greatest thing ever. And it's changed my life dramatically. But you have to learn how to use it, right? And you have to learn how to be a little patient. And you have to wait for advantages. And you have to be willing to say that if price reaches resistance, even with a green background, and if price reaches resistance, even with the smalls above the large, that this isn't your long trade. And that's okay, right? And then the flip side is that when the smalls are below the large and there's momentum, you're going to take one on the chin every now and then. Guys, this is a great look. And it lost. And the market's just kind of doing what it does. So put the work in. If I reach a divergence low and the triggers remain above, don't go short, silly. It's a termination condition. Rules are designed to keep you safe. But you've got to go back and you've got to get that trust and you've got to get focused. And it goes back to the whole this is my favorite thing in the world to put in the room, guys. Too many mind. Mind the sword, mind the people, mind the enemy. Too many mind. Guys, just keep it focused. Keep it concise. Keep it the best of the best. Your money is worth it. I promise you, your investment is worth it. Your money is worth having momentum and a clear path. And then the entries come second nature. So that's my first hour. I apologize for the little soapbox there. But Bob, there's hope, brother. All you got to do is reel it in. Don't work so damn hard. When is the last time someone told you that? Stop working so hard and you'll probably get better results. The reality is you're going to spend 6 hours every day in front of your computer. You're going to spend 36 minutes trading. It's the greatest job ever, guys. It really is. I'm going to be on the golf course by 1:30 today. Why? Because I'm going to follow my rules. I'm going to make my money. And then I'm going to go suck at golf because I was good at trading. So, That's my first hour, guys. It's the first hour every day. Thank you for listening to me rant there for a minute. I do it because I really do. I'm invested in your success. The path hasn't changed in decades. Post your pictures, use your spreadsheet, learn your rules, and then, guys, be willing to say it's not my trade if your rules aren't met. But here's the flip side. If you have momentum and a clear path, don't miss that darn entry. Put your entry 2 ticks below resistance and run that thing down to support. Did anybody catch the short there? I hope you did. I'm going to take 5 minutes. I'm going to encourage you guys to take 5 minutes. If you sit and stare for too long, most people make stuff up. So when I come back, we're going to look at the charts you guys posted. We're going to answer any questions that you want, and we're going to get into that second half of classroom, guys. I'll see you in 5. right, let's get into that second half of class, guys. So I'm going to go back in and I'm going to scroll up to the very top of the day. And I'm just going to start clicking on charts that you guys have posted. Every time I click on a chart, I'm not going to worry about winners and losers. We're going to talk about advantages. We're going to focus on the entries that you took. We're going to focus on the exits that you took. And we're not going to worry about anything other than advantages. Doesn't matter what kind of trade it was. Doesn't matter what you were looking for. J. Roth got us started. 3 divergences coming from a termination that reversed the market. He says, man, this market's going down. He did have odds favorable. Your entry is a little interesting. You put a sell order on the reversal at the magenta line, waited for the order to fill. Once it filled, it looked at the large chart, placed a buy order just below the resistance line. All right. So Jay Roth, are you in here? So I like the idea that you were going short, right? What a great thing. What made you feel like the magenta line was the entry up here? And I ask just because I love the charts. This is where I place the sell order. Absolutely. But why? What about this chart made you want to go short here? What about this chart made you feel like the short was here? And then the real question is why not at the mid-band inside of favorable large triggers with that look, as opposed to out here in space from the wrong side of everything? Does that make sense? And I ask just because I'm curious what your entry rules are. You thought it would hit that and bounce down. Okay. It didn't. Cool. I guess I'm trying to figure out how to say this without sounding like a jerk. I think it's going to happen, right? So let's go with, just for grins, indicators say, if you're cool with that. Because I think it's going to go down as great, right? So I'm just going to go through and I'm going to come through and I'm going to say rule 1 is momentum on the large chart, right? And we have it without a doubt. It's beautiful. Rule 2 is a clear path, and once again, it's there. It's nice. I like everything about it. J-Roth, your large chart is 100% rock star. The challenge is, and this may be just a different thing, you thought that it would bounce off of the pink line. Rule 3 says area inside of triggers. And I'm only doing this so that we can talk about what I see and what you see. This, to me, per the high probability trend trade rules, that's your best entry, without a doubt. That is the most likely point of a bounce. I know this because I've gone back and I've seen this look 700, 800, 900, 1,000 times. Up here is on the wrong side of everything. Up here doesn't have an area to bounce. Up here fights the small triggers. Up here, the large triggers have already rolled. The mid-band is green. This is, I hope it goes down, kind of entry. And this is a rules-based, and it was a loser, without a doubt. And this is where it's easy to say, well, I made money, so it's got to be great, right? But if we go back to my wish and hope for you guys each and every morning, is making sure that you're practicing the correct trades, because there is a statistical advantage, because it's a trade that's repeatable, that you can find that wins more than it loses. And I think what you'll find more often than not is when you get to the wrong side of things, it's less likely to continue in the direction of the trend. When you get to the wrong side of those correction points, it really is, it's more difficult to believe that that market's going to go down. So congratulations on the win, absolutely. And I hope it doesn't feel like I'm beating you up. But without anything at all to support this one, it's a difficult trade to repeat. And I think that if you went back and looked at it, maybe just a little confirmation for continuation might be advantageous. So thanks for giving me the opportunity to review that one. Rule number 3, and I love that it's a winner. I love that it's a winner, guys. I always want you to win. Makes me happy. But I want you to win every day, and I want you to win consistently, and I want you to talk about advantages every time. Trigger's headed down. Direction is down on the 13.2. On the 5.1, you see pull back into favorable large triggers at the mid-band. All right, Rob. Are you with me? And sorry, I know okay is that. I wish you hadn't said that. So a couple things, Rob. The first thing is this chart. I'm not sure where you're pulled. Was it back here? I see your circle up there and I see a circle over here. And I know you're probably just scrolling back and circling tails, right? So what helps me a lot, Rob, is if you get, one, don't cover your circles with text. Move that text over. But show me the circle on the small chart too. But you're saying this one pulled back to a mid-band inside of favorable large triggers up here? Perfect trade then, right? I can't see it. But your large chart is perfect. So it makes sense that it would be. Pull those together though. Get those two together so you can kind of see where everything's going on. And that's just going to let you burn that image into your mind a little bit. Does that make sense? Great read, great circle, great everything. We just want to be able to see it on both charts so that you can come back and repeat it every day and make it exactly what you want it to be. And then the triggers are headed up. And again, I can't see your entry. I'm not sure where the entry is, but you're right, the triggers are up. Pullback wasn't into favorable triggers, so it just wasn't a trade for you. I love it. Following those rules. Great job, dude. Starting to piece it all together. And then Paul, strong triggers into the mid-band. Big gap in the triggers. No entry. No, you're great, dude. Keep doing it. Keep doing it. Oh, so you just circled the HVA? I got you. So the first rule of an HVA, though, Paul, is a good no triggers termination condition. This definitely didn't have it, which makes it a little problematic, without a doubt. And then you want that HVA line inside of the triggers, and it wasn't. And this is really just kind of hoping it goes down. It's a good spot using that HVA line to line up with everything where you're anticipating it to hold. Doesn't quite fit the HVA rules, but it does line up with resistance with the triggers rolling, strength down, and it is a pivot stop out. You're just kind of hoping that it breaks and you had plenty of room to get to the trouble. Good read, man. I hate this look though. Those split triggers, it just increases risk. Great read though. Spot on. Haji, look at this. I didn't miss your trade. If you didn't catch the HVA like Paul was looking for, everything says down, let it break, pull back. I mean, holy smokes, Haji. What a beautiful trade. You tighten target 2 inside of divergence. I like it though. Quick profits, problem area, and that's where you just let that last one run. Just give it wheels, man. Great job, Haji. Beautiful trade. Vittorio. Woo. Oh, I remember this one. We kind of did the same thing, right? Vittorio giving us the lesson. So what is a good top or bottom? Man, I love this. I love this. So a good top or bottom, and I'm going to take a picture of your picture. When we're talking about a good top or bottom, when we're talking about that precursor to the highest probability, oh, you're doing great, Rob. So we're going to say a no triggers through termination condition that reverses the market. Is everybody comfortable with that? Vittorio, you're cool with this one, right? This is going to be the standard to which I hold you on this trade, guys. When we talk about a good top or bottom, we're talking about a no triggers through termination that reverses the market. This is the most basic form. So not a termination, perfect. Not a termination, perfect. No triggers through termination condition that reverses the market. Beautiful. Vittorio, 3 for 3. Didn't quite make it. Beautiful. Perfect. Yep, that's a good top. And then it takes you to a bad bottom. And then it takes you to a good top. And then it takes you to a good bottom. Oh, Vittorio, you were doing so great right up to there. So now I'm going to put it on you, Vittorio. What's the one thing that didn't happen on this last one? And everything else is 100% spot on. Guys, this is such a great drill. But what did we miss on the last one? What do you think, Vittorio? What didn't happen? We got a zero triggers termination, but what didn't happen? Notice how the large triggers never even bent. They just stayed up the whole time. Do you see it? So resistance gave a bounce, but notice how the large triggers never reversed? So that's not a good top. That was just a termination condition. And I can tell you I went long from there to there because these large triggers never rolled. Awesome work. Everything is 100% spot on. They just never gave you the roll here, so it was just a termination, not a good top. Man, I get giddy when you guys go back and do the study like that because you're going to be so good at this stuff. Green large chart, momentum, buy and trade once the bar broke, resistance, pulled back, easy money. I mean, goodness, Grant, perfect. Guys, this is a momentum trade. Everything says up on the large chart with strength. Smalls outside of the large. Smalls break resistance. Price pulls back. I mean, picture perfect, Grant. Welcome to Nexgen. And this is a tough one, right? Weak triggers at resistance. It's likely to hold. I'm not sure what got you in long here. What made you go long here? I'd be curious. I'm not knocking it. I'm just curious. And then small triggers down. Everything says down. You wait for it to break below and pull back, momentum style, down to there. Absolutely beautiful again, Grant. I love this short. I can't figure out the long because you don't have momentum and you're on the wrong side of everything. It's an interesting look without an area. But the short that follows it, absolutely, 100%, easy. Green larger chart, everything says up. Once again, absolutely. You jump in, and then it gives you your pullback to get up there. Brain fart, that's cool. Brain farts happen. Annotate your brain farts, though, Grant, especially when you get lucky. And I know that seems silly, but annotate your brain farts. It's okay. It's okay to make mistakes and stuff like that, but the key is to identify what the mistake was so you don't have to make it again. And then this one, you got a little jumpy and didn't wait for the pullback, right? And then there's your pullback. Isn't that cool? I love it when this happens because it reminds us that it's patterns. Perfect stop placement. Everything says up. Momentum is incredible. Let the smalls break. Take the pullback. Take it up. This one actually gets you in a few ticks better. And then right here at 80, these 1-to-1s coming into it, that's a great target point. Great profit target. Nice trading, Grant. Great job. And then Paul, not a lot of pictures being posted today. That's okay. Great looking setup, but rule number 2. Paul says, even though it looks beautiful here, termination condition said don't take the trade. I like it, Paul. Joel, perfect. Absolutely beautiful. Same one that Haji took. And then Grant, I saw that you said sorry you have a few pictures from this morning. Guys, don't ever be sorry. If you need to focus on your trading and then just drop 10 pictures in, drop 10 pictures in. We'll look at every one of them. Joel, picture perfect. All right, Arnie. Probably not the greatest bottom. Strong triggers into support, triggers and price broke, no divergence. Dun, dun, dun. So you went long and got run over. No worries. All right, Arnie, I'm going to show you how easy it can be, my friend. Are you ready? One of the coolest things that we're going to do is we're going to eliminate the word probably. We are going to 100% eliminate the word probably, and this is exactly what we're going to do. Is we're going to say, and man, this is the one that I don't give up. This is my favorite rule. So, whoa, that's big. Let's make that smaller. All right, so the background is green. And you're looking for longs. And I like that. And that is solid. And then rule number 1, and guys, this is the one that I don't give up. I need strong triggers. And one of the best lessons I think that you can get as you go through that 101, as you go through that beginning process, is that if my trigger lines are red and my background is green, I can never have strong triggers. It's impossible. It can't be done because the only way that I can have strong triggers is if both the background and the trigger lines match. Does that make sense, Arnie? And really anyone else listening. The only way that you can ever have strong triggers is if the background matches with the trigger lines. So what we had here is you got a great bounce off of support, and I agree 100%. And then it pushes all the way up, and notice how the large triggers don't follow, and you're going to see that a lot as you begin to recognize patterns, is those large triggers just simply don't follow. And price comes back to them. And you're looking for that retest of fib, right? There's your entry. And there's your fib. And there's your entry. And there's your fib. So you didn't even we didn't really get that chance to retest the fib yet. Maybe it bounced and came back up. You entered the market, it was too slow. Cool. So rule number 1 wasn't met. I would agree with you 100% that rule number 2 is okay. All triggers are above support. You do have a clear path to the upside, right? But you're doing it without momentum. Remember, we're just going back to this one. So I don't have momentum, but I do have a clear path. So far, so good. I'm fighting the triggers. I'm with direction, but everything's above support, and logically, support is likely to hold. So rule number 3 says, and this is the part that would keep you out of this trade, area inside of triggers. And the key is, if we're going up the triggers should be going up as well. What happens here at the time of entry is your small triggers are down, your large triggers are down, your synthetic triggers are down, your direction is down. Does that make sense? And I think you're absolutely right. After support holds, that's probably a better shot at going up. And then when it can't do anything, just being a little patient and waiting. Yeah. Well, not even that the momentum was against you, but you had none in your favor. Um, and then the smaller, faster momentum indicator, when it turns down against you, that's against you as well. And this was odds favorable against you. But remember when we talk about entries and we talk about areas inside of triggers, if everything matches, life is easy. If the background is green, if the triggers are green, if the momentum is strong, if everything's green, it really does make for a pretty easy trade. When you start getting these color mismatches, it means that you're definitely fighting. And then if we go back to this, we didn't really have an entry area. So the only thing that we had going for us was that 33%, right? We gave up 66. But you get rock star of the day because you posted it and you talked about what you saw and what you were thinking. And I think you're right. This was a termination. It never actually reversed. If there were divergence here, it would have strengthened the chance of this holding, without a doubt. But because it didn't, let's talk about one more pattern that you guys will dig, and it'll probably help a lot. Let me get all this nonsense off of here. Is if I come into an area with that much strength, even with the push up, if these triggers don't really follow along, they're probably going to retest it. And then I'll make decisions here on the retest. I won't make a decision until it comes back and retests. And this is where you'll see things like pivot stop outs. This is where you'll see a small chart that rolls. And you get maybe a pivot stop out and all the areas are holding. So I think it's a great picture. And I think that it was using a great read of a termination that created the push that changed the trend. And then we're just going to incorporate a little bit of a patience piece so you don't get run over like that. Great picture. Great post, man. Thank you for that. And then Paul, termination. 1, 2, 3, 4 divergences. And then Paul, stop filled. So on momentum trades, Paul, maybe he's running the kids. Hopefully he's not. Guys, when you're looking for these momentum trades, you don't want to trade into one-to-ones. What you want to do is you want to break those one-to-ones and trade off of them. Let your small triggers break through. And I don't know if Paul's listening to this one, so I'll post it in the room for him. So when looking for, not Lewing, and that'll certainly help a lot. We'll see if Paul gets that. So you guys that are looking for momentum trades, let the triggers break. It'll create a huge advantage. Let the triggers break the area and then pull back to it. Grant showed us some great examples of that. Let the triggers break and then pull back, and it creates a huge advantage. Weak triggers in, there's your push, and now we're back at it. And we're just kind of waiting to see what happens, but crude is in a grind. Smalls are above the large. Smalls are above the area, large are not. There is no divergence, and it did pull back to support at the triggers. I also have synthetic triggers down here. So Arnie, there's your 50-50 trade. Smalls above, Large below, odds favorable momentum. It does take patience, Rob. It does take patience waiting on triggers to break areas. You know, my brother used to ask the class, and it was kind of funny. So if Elon Musk called you up this morning and said, "Hey, Rob, I've got this great job for you, brother. I need you to sit in a room for 8 hours. And when the conditions are right, I need you to click the mouse. You're only going to click it 4 or 5 times a day. But I need you to do nothing for 7 of the 8 hours. But I'll pay you $150,000 a year." Most people would do it, right? Most people say they would do it. Trading's no different, guys. So Arnie, always start, says up, have momentum, 50-50. This is the large chart read. It sucks to do nothing, Rob, but what's cool is when you do nothing, it works. Man, we all do. We all do. So we get the reversal bar, and at the time of the reversal bar, our job is to look from the top of the triggers to the bottom of the triggers, and then to find the areas within. So technically, there's your window of opportunity, Arnie. If you're going to take this trade, if you're going to take this 50-50 trade, you're probably getting in somewhere in this box. Does that make sense? And here's the challenge with triggers that look like this, is it might come close the gap down to here before it goes. So on a trade look like this, when the triggers are split, if you're gonna take this trade, you've really got to wait for the reversal bar. You can't just put your stop right here. You're going to get knocked out more often than not. Once the reversal bar prints, if you got in at support that you anticipate breaking, well, then you've got that risk established because of the momentum. The momentum's outstanding. So if you took the trade, the risk is a little larger because of the split trigger, but your risk would be established. But the area is still not broken, right? So you've got to get into that management mindset inside of the large triggers. So the area is inside of large triggers, but your synthetics are all the way down here. And that's that split trigger look, which means, let me find it. Split triggers means that it could drop down to them. Does that make sense, everybody? You can get in at the area inside of the triggers, but when the triggers are split, it may drop down to those synthetics, which means that you've got to manage appropriately. You can't put a stop in the middle or it's just going to knock you out. So you can do stuff like, I'll wait for a reversal bar, right? Or I'll wait for it to come down and close above, or I'll do something like that. So then I at least got it, and your risk is established. So you could have taken the long. No divergence makes it better. Strong triggers makes it better. Multiple areas of support makes it better, right? And now you're into that management side where you're like, okay, I'm in a medium probability trade. This area still hasn't broken. So if divergence prints, let's see if the market plays along. If divergence prints, there's a good chance it's going to pull down to the synthetics. So we'll wait and see how this one plays out. Weak triggers, deep retracement, straight to mid-band, straight to one-to-ones. Large triggers remained a full bar away. Ladies and gentlemen, that's what we call the gap theory, which meant that if you went short right here, it was the equivalent of financial suicide. Does that make sense? Weak triggers, anything can happen. You did go short right there? Notice how the path wasn't clear, Arnie? Directly into one-to-ones, directly into a mid-band. Look at where your triggers are. They're so far above. There's just no reason to believe that's going to break. Gap theory is in place, finds its way back up. And now if it's going to continue down, it's got work to do. It really does. And this is the boring part of trading. But if you were watching it over here, that looks pretty good, doesn't it? But then 3 divergences takes you out. So now we're just in that waiting. Is it going to break? Is it going to hold? I don't know. All of my triggers are above it. So we'll just have to come back and see what happens. Weak triggers at a termination condition, not going short, but there's a fight. That's the fight, guys. That's the decision-making process. We're waiting to see what happens on crude oil. Area is still not broken, right? Is everybody comfortable with that idea? The area is still not broken. So it's a different type of management. If divergence prints, I'll exit the trade. If divergence never prints and I'm in at the mid-band, well, then I'm just holding for the next areas. But I have to manage this differently than I would a high probability trend trade. And I think that's the key right there. And guys, I think we made it through all of your pictures. So this is kind of the cool part where you get to run the class. What do you guys want to talk about? Grant, you're becoming quite the momentum trader. I like it. Let me know if I can help with it. Gino, how are you doing today? You're quiet. Well, that's the one thing that I wanted to post in here. And I thought this when I took a break and I forgot to say it. If you're one of my people that are struggling, right? If you're one of my students, one of our clients, and you're just like, man, I'm just not where I want to be, right? And I'm not trying to put anybody on the spot, but if you told me today that you're struggling a little bit and you haven't been posting charts in the room, why not, right? You're chasing trades today, Gino? That's tough. That's okay. Take a deep breath and stop. It's hard to do sometimes. But there it is. So Arnie, here's your living example on the 50-50, right? It was pretty short-lived. Split triggers, now divergence prints. Let's see if it comes back. It might not, I don't know. But do you see how they're fighting at the key area? And guys, this is such a great lesson. If I put a rectangle around this, look at all the bars inside of this one bar. That's the fight at the area. That's the buyers and sellers trying to figure out who's going to win. It's a knife fight. Well, it's a gun fight, and if you are trying to trade it, you brought a knife. You might not even have a knife. I don't know. But I wanted to put that out there, guys. Don't ever suffer alone. If you're struggling, post in the room. If you're making mistakes, and you know you're making mistakes, post in the room. Even if you know what the mistakes are, what you'll find, guys, when I make a mistake and I send the picture to my brother tells me exactly what the mistake was. I know what the mistake was, but by him telling me, it reinforces the lessons. It just kind of goes, man, Mark, you know this is wrong. And then he comes in, he goes, dude, you know this is wrong. Why did you take that trade? And it forces me to think about it. And that's kind of what we do. So if you went long at the mid-band and you stayed in through divergence, you're probably getting a little worried, right? You have to have a management plan for the type of trade that you're taking, whether it's a high probability trend trade, a medium probability trend trade. You have to have a concrete set of exit rules the way you have entry rules. Jeremy, good top. You took the momentum. And it just got you. That's okay. I do like the look. I think that the biggest challenge on this one is look at where your small triggers are. See how they're still inside and almost above? I really feel like that's a thing. is when those smalls come down and get below, it makes this trade a lot easier. It really does. But until the smalls get into that momentum phase, it's likely to pull back up, right? Because the whole idea is that it closes back to the small triggers, which puts you all the way up here beyond that one. It's still a good look. I know it fits your plan, but watch those small triggers. And Haji, I'm going to go 10 for 10 on you today. And I love this. Haji takes the 50-50, right? No divergence, perfect entry, quick profits, not messing around with divergence. All right, Haji. Virtual high five, man. This is how you handle a medium probability scenario, ladies and gentlemen. The best entry reduces risk. Strong triggers is great. I know, right? And this is my favorite part about it, is that you got paid and you didn't hope because the area didn't break, right? And what's it doing? Holy smokes, I drew too much on my charts and I crashed NinjaTrader. It's like, where did my charts go? Great job, dude. Grant. Red chart. That's only part of it, though. Notice that support and it bounced. Entry at the third bar. Entry was green when large chart was red. Grant, great job. Let's try this real quick. Because I see you trying to pull off the trend trade there. See if we can make these a little bigger. All right, Grant, talk me through this. A wire and N. Do you have any momentum at all on this trade? I'm going to show you how easy this can be. Would you say strong triggers or weak triggers? And guys, you're never obligated to play along, but you'll get better, right? So, all right, so weak. So all we're doing is we're identifying, right? Red chart is great. That's just the first thing. No, they're not even weakening. They are just flat out busted weak. Look at the smalls. They're flat and inside. There's nothing going on there that's good at all. And that's cool. That's great recognition. And then the second part is, do you notice how with weak triggers, you also have a termination condition? Those one-to-ones are one of the areas that we look for, and no triggers through means that that is a termination condition, 100%. So while the chart is red, it is going down, you don't have any momentum on your side, and you also don't have a clear path on your side. Does that make sense? And this little speaking to yourself in terms of advantages, there's nothing to see on the small chart yet. That's the only chart that we're looking at right now. So your large chart will have one-to-ones that your small chart doesn't. Excuse me. That was horrible grammar, because they're two totally different time frames. And let me show you. So these have one-to-ones at 18, 3, 12, 25. This is a 34.5 chart on the NASDAQ. These have one-to-ones at 18, 3, 20, 50, because your large chart NASDAQ is measuring swings here to create these one-to-ones. Your large chart is determining divergence based on the pivots there, small swing one-to-ones. And then your smaller chart is so many more bars that you'll get different divergences, you'll get different one-to-ones. So And that's pretty, I think it's interesting that you said that because it's not something that I thought about. So you're not going to see these one-to-ones over here. And that's why we use the large chart for termination conditions, because those are the ones that create problems, is the large chart. And then the small chart's just an entry chart. So if you're looking for the short, ideally you want everything red, and you notice that. But if you let the large chart lead the way, then you never even look for this short. And you actually say to yourself, weak triggers at a termination condition, this is a market that's probably more likely to hold here. This is a market that's more likely to bounce up, and we'll see what it does. And it looks like it did all the way up to the mid-band as that one's loading up. Does that make sense? And this is why I'm so adamant about you guys. Start on the large chart. Let the large chart lead the way. Let the large chart tell you if it's time to look for an entry. Because what's cool is if you look at the large chart and you're honest with yourself and you say, I don't have momentum or a clear path, what it does is it just keeps the powder dry. You're like, I can't take a trade just because of an entry area. Or if the large chart doesn't have momentum, but you do have the clear path and an entry area, you might say, well, I'm willing to manage it aggressively because now it's medium probability. So I think it's a great picture, and I think it's an awesome lesson just to remind you to let the large chart lead the way. And it's crazy how much it keeps you out of. And then, Dwight, you took the 50-50 as well. Not from a good bottom. Strong triggers, large not through, clear path. Not a clear path if the large aren't through. You do enter by the triggers, missed profits at the second divergence. This loss feels good because I understood the conditions and moved the loss up to decrease loss. Awesome. So, Dwight, the one condition that I think you may have kept out of the equation is this one right here. And this is where I think language is so important. Is you have to make sure that you understand whether the path is clear or not. So if you say small through, clear path, then you're taking that medium probability out of the equation. You're saying to yourself, man, it's good, it's great, right? But if you say it's not a clear path, then this becomes an exit condition, and you actually get out of this one break even, right? And it gets you focused on taking quicker profits. And at 40, take $100 at 42, right? Get to break even on this trade. Get paid. It's a medium probability. And I think that one little language piece changes the whole dynamic of the management. Does that make sense? I'm glad that you decreased your loss. Yeah, awesome job, dude. Great job. And those split triggers too, right? Those split triggers are ugly. Those split triggers will ruin a party all the time. And then my chart's trying to come up still. My crude oil's having problems. And then Arnie, good tops, bad tops on the large chart would trump similar looks on a small chart. So you're saying if this were a good bottom, this is more likely to work? I just want to make sure that I'm understanding the question. I hate that term trumps. But if I have a good top or bottom on the 13.2, these 50-50s are indeed more likely to work. And you're exactly right, Dwight, 100%. And that's why I feel like the very basic language becomes so important, because it lets you know which management hat to put on. If you had a good bottom on a large chart, but a good top on the small, buying a pullback long would be sketchy. Here's the beauty of it, Arnie. Even better. I'm going to give you one less thing to think about. There's no such thing as a good top or bottom. No such thing as a good top or bottom on the small chart. Good tops and bottoms only happen on the large chart because a small chart's not going to reverse the market. Pretty cool, right? Let me share this picture. And Vittorio, thank you for doing work for us. There's a great idea of great tops and bottoms. And it always happens on the large chart because the large chart defines our areas, and areas are where decisions are made. So when a decision is made here, it can make a 50-50 up here better, right? Or when a decision is made here, it can make a 50-50 here better too. And the one thing that you may notice here, guys, is rule number 2, defined consolidation for hours. And my crude chart is refusing to load. Let me see if I can. I've got to restart my NinjaTrader. Hold on just one second, guys. I'm just going to end it and start over. But great question. And Arnie, these are the questions, guys. I'm telling you, these are the questions that will absolutely take you next level. If you wonder something, ask the question. If you think something and you're not sure, ask the question. Man, I hope so. Like, don't ever stop. The best classrooms that we ever have are the ones where you guys are the most vocal. The best classes that I've ever taught had absolutely nothing to do with what I teach. They had everything to do with what you guys wanted to learn that day. Be selfish with your time in this classroom. Be selfish with the information that you need. Don't worry about whether or not you're asking too many questions. Don't worry about whether or not you're posting too many charts. I've never had anybody post too many charts ever in the history of, we're going to bring these back up. In the history of this classroom, nobody's ever posted too many charts. Nobody's ever asked too many questions. Paul will tell you, when Paul started with the software, Paul would do market replay in the evenings, and he would come to class with 10 to 15 charts every day, already loaded up and ready to go. I want you guys to do that. I want you guys to use market replay. I want you to scroll back historically. I want you to write your rules on the chart, and I want you to really just say to yourself, man, this is going to be my job. I'm going to give it everything that I have. You're a freshman in college, and you don't get to build bridges as an engineer until you pass everything. So be selfish. Be selfish with the pictures. Take 1,000,000 pictures. Drop them in the room. Stay focused. And then for you guys that are new, I'm going to share this one while stuff loads up. Let me make it bigger. To minimize your learning curve, post pictures of your trades in class, right? Every trade, win, lose, or draw. Because if you win and the rules are wrong, you may have a short-term victory, but a long-term failure. And how are you going to know the difference? And for those of you with thin skin, when you win and you're feeling great, and I tell you you got lucky, it's going to sting. But it comes from a place of love. It's because I don't want you to hurt yourself. I won't tell you how to trade, but I'll definitely point out disadvantages. How are you going to know the difference if you did it right or wrong? You need feedback. That's what we're here for. And if you're on the simulator participating in class, guys, you can't lose money. That's the beauty of it. You can't lose money on the demo unless you're silly enough to go live. You can't lose money during the study process unless you're silly enough to go live. You just need someone to tell you what you did right or wrong. And that really is the magic of what we do here. So embrace that. All right, let's see. There's that S&P 50/50, guys, and it never went. It never went. And I have a data corruption issue somewhere, I can tell. Simulate, market replay, all that good stuff. And then one more for all you guys. The key is having a foundation, guys. Understanding the basics. As soon as you can talk to yourself in terms of advantages, and then Dwight, thank you for the awesome example on that. When you talk to yourself and you say, man, I don't have a clear path because the large triggers aren't through, it puts you in management mode, which is great. My brother, oh my gosh, my brother reads charts so fast, has such a database in his head of patterns. He manages trades that I would never even enter. He pulls $200 or $300 off of because he's in a different place. He's a chart reader, more so than I am. And management's huge when you know what you're getting into. When you know there's a problem, you're going to get paid quick because you know that it may not be a home run. So for you new users, what does that mean, Bob? I don't know what that means. Oh, on the large chart, it's going back to the synthetic triggers? How did we know that was going to happen? Didn't we circle that like 15 minutes ago? So there's your pattern, split triggers, right? All you got to do is learn it, trust it, keeps you out of the trouble. Guys, I blanket you all brand new with very conservative rules. And everything revolves around recognizing advantages. Everything revolves around really putting yourself in a position to have the best chance of success, because that's where confidence comes from. Where did my S&P? That is an ugly chart, right? So you got to reload historical data. Everything comes from just finding the best of the best. So if you're brand new with me in this room, you're going to get sick of me telling you that momentum should be the only thing that you look for. You're going to get tired of me saying don't trade in determination conditions. And you're going to get bummed when I tell you those split triggers are ugly, or trading from beyond those triggers is low advantageous. And the reality is that all those things aren't bad. They're not necessarily a negative. But if you're brand new and you're not reading your charts rapidly, the more you fight the very simple process, the more difficult it becomes to manage. And the more difficult it becomes, the more frustrated you become. And the more frustrated you become, the less likely you are to focus on advantages. You start focusing on those revenge trades, getting your money back, all that sort of stuff. So the more time you spend with it, the more you're going to see. And then this is huge. One of the biggest challenges that new users have is they see the more experienced users. And I see it all the time. I'm going to call it the John Novak theory. People see John Novak trading, and they're like, well, I want to do what John does. And they forget that John wrote the software 27 years ago, that John has been studying patterns in the market for half of his life. And he just sees things that we don't. So it creates a little confusion. Well, how come he could do this? How come he could take this trade? Well, it's because he's John Novak and he's got that chart reading. The same way Ron C can take Ron's trades because he's Ron. He's put the time in. Jeremy takes a different look because Jeremy studied the look. So the more time you have, the more you're going to understand when it's okay to break rules. The more you're going to understand when things are changing. I'm still calculating, but yeah, that's going right back to the synthetics, right at the one-to-ones. Isn't that amazing, guys? That we can kind of call our shots just based on patterns. Then you get JW that says weak triggers but divergence printed. And what does that mean to you, JW? Midband's the first target, right? Weak triggers with divergence, midband's the first target. And look where he got out. And he just let it break. Let it break, hop in, hop out, just momentum. But he knew where to get out, and he'll wait for the next best. JW, I love this trade. Does everybody know that weak triggers from a bad top, you're pretty likely to hit the midband? Not guaranteed, but definitely likely. JW knew it because he's probably taken pictures of it 100 times. Split triggers, guys. The area never broke. Look at the fight. We're only on 1.5 bars over here. Out freaking standing, isn't it? So learn the looks. Don't worry about the trades at first, guys. Don't worry about the trades. Focus on the advantages. Make sure that you understand these 3 key concepts: momentum, clear path, and an entry area. Make sure that you don't put the cart before the horse. Trading with direction is outstanding. Trading with direction and momentum is even better. Trading with momentum, direction, and a clear path, the angels sing. And then when you have all that, great googly moogly, buy support inside of favorable large triggers on the small chart and wait and see what happens. But the process leads to the money, guys, not the other way around. You don't play scratch golf because you want to play scratch golf. You play scratch golf because the mechanics are there. You don't hit home runs because you want to hit home runs. You hit home runs because you have sound fundamentals, because you know how to hit the ball. Cindy, how many times did you go to set someone up for a spike and have it ricochet off the side of the heel of your hand, go out of bounds, lose the big game, right? But eventually, through repetition and practice, you never missed a set, right? You never missed a spike. Used to play sand volleyball, and I was that guy that would jump 2 seconds too early, and then I'd try to spike it from knee deep in the sand. So it's the process, guys. The process yields the results. So give yourself time to learn. Learn to read the charts. Ask a million questions. Post a million pictures. Be selfish with your time in class. It's okay. Always let the large chart lead the way. Always let the large chart lead the way. Let the large chart tell you that it's time to look for an entry. Don't let the small chart talk you into things that the large chart doesn't support, excuse me. It's Monday, right? We'll open up crude oil and see what it's doing. What do you guys want to talk about? We have a few minutes. We got some time. What's on your mind, guys? Don't let fear rule. Amen. Let love rule, right? I think, I can't remember his name. Lenny Kravitz said that. Let love rule. Use a checklist in the beginning. Police yourself. Let's use the Googles. I can never read these though. 323 expiration is 317. So it looks like the 17th rolls on the 13th. And you're absolutely right. Do you know why, Arnie? Because they follow checklists. Because they're not allowed to go in the air until the checklist is true. Amen. Engineers are the hardest to teach. They really are. Because engineers overthink things. Monday feels like a sloth. It does, right? Engineers overthink things. If an engineer's like, okay, well, if small's outside of the large mean momentum, well, then doesn't each increment of small outside of the large in reference to the angle divided by pi squared over, doesn't that mean that the advantage is even better? Way too many variables. Watch this, guys. Large chart. Oh, my stuff is suffering, but let's just do the large chart here. Is there a rules-based trade right now, guys? Can you guys see it in the moment? Price reach support, no triggers. I'm bypassing everything because I see price smacked into support. I don't have separation between the small and large. Wish in one hand, poop in the other. Tell me which fills up first, guys. You don't have a rules-based trade, no matter how much you want that market to go down. No, it's not even possible, Cindy. It is 100% termination. It is 100% without question, no doubt. Can't sell it to me any other way. Because in the moment, price reached support and no triggers broke. Now, it doesn't mean that it's not going to break. It doesn't mean that it doesn't have a chance to go down. Especially coming from that resistance, right? It could break. Or it could bounce. Or they could fight. So if I don't know what it's going to do, all of you control freaks have trouble with that. If I simply don't know, what should I do? As someone that wants to hold on to money instead of just give it away for no reason. Just sit. Just wait a minute. Especially if you're a NASDAQ trader. If you're a NASDAQ trader, there's 20 to 25 trades a day. Easily. Easily 20 to 25 trades a day. If you're not like me, if you don't miss 3 hours worth of trading, you can still make your goals. Some days I make it before class ever starts. Sometimes I have to trade a little bit after class. But guys, there's easily 20 to 25 trades on the NASDAQ. There's easily 5 to 7 trades on the S&P and crude oil most days. You don't have to be in the market every minute of every day. You don't have to be in every move. You don't have to catch every top and every bottom. The easy money, guys, the easy money happens in between fibs. The easiest money happens when you have, let's find a great example. When you've cleared support or cleared resistance and haven't made it to support. That's the easy money, guys. That's the money that's effortless. That's the money where everything agrees. That's the money where life is good and people are happy and children sing songs about you. And I'm getting frustrated with my NASDAQ here. So take time to learn. And then I'm going to share this because we're at that point where nobody's posting or asking. Psychology of trading. This is huge. I'm going to give you guys emotion-free trading in the room again. I like to share that as often as I can, but learning to trade at a high level goes beyond simply making money. It involves understanding which patterns can be executed confidently, which comes through trading, both winning and losing trades. Embrace the learning process and don't fear losses. As long as you share your trade outcomes in class to promote growth and prevent repeating mistakes, keep your focus on consistency and achieving successful results through your efforts. That's not trading advice. That's just talking about the psychology. Nexgen emphasizes that new traders should complete their education using the simulator, market replay. A lot of traders make the mistake of going live, testing their plans with real money without a winning mindset. Trading an incomplete or poorly developed plan often leads to avoidable losses and frustration. I've given you guys a concrete plan. Nexgen's patterns provide a statistical advantage. Focus on the advantages, guys. Question in, stealth mode on. Where's the question, Haji? Did I miss a chart? I didn't miss a chart. What's the question? Tell me what you got. What is your question? Erg. Hey, look, it did break, didn't it? At 11:30? Oh, the midband being the targets in some situations, for sure. Let me find an example. When it's not a good top or bottom, when a pivot's kind of coming from nowhere, divergence and weak triggers, the midband is going to be my first target. That's not a picture of it. So divergence and weak triggers, that midband becomes the first target, and that's all it is. So if, I'm going to see if I can find some good examples. Divergence and weak triggers, midband's always the first target. Divergence makes it a little more powerful, and of course it's not going to give me a bunch of examples here. Divergence, weak triggers from beyond the area, midband's the first target. There's the first shot that really comes in. And it doesn't happen all the time, and it doesn't mean that it's going to stop at the midband. And I think that's the key. But if you know that the midband is the first target, Haji, then what it does for you is it maybe keeps you out of this 50-50, or it keeps you from trying to go short into that midband because it wasn't a good top. Does that make sense? Weak triggers with divergence, midband is the first target. That's the one that I was looking for. And then when it gives you a second lower divergence, it becomes more apt to finish the move. I knew I had a picture. There you go. Since I've missed so many of yours, let me give you one. Erg. I'm going to build a new chart. See if I can't fix this. What do you guys want to talk about? Tell me what you want, what you really, really want. Is that crude oil? That's NASDAQ. What you confused about? What do you need help with? What's going to make your life just a little bit easier having known it today? Pedro, trade eval, you got it. Odds favorable momentum. 50-50 at resistance. One divergence. Pulled back to support just above favorable large triggers. Hope, there's a word. Hope to get at least a previous divergence and maybe next major resistance. How did that turn out, Pedro? Did it come down against you? And I never root against you guys. You got both targets. Awesome. Momentum for the win. It's a bad bottom, but 3 divergences in the same price range suggests that maybe it might be going up. You're 50-50 not only here, but also on that divergence high, right? So there's a little bit of a problem going on right here and a little bit of a problem going on right here. But you've got tight, favorable large triggers. You have the perfect entry area. It's very low risk. And once the reversal bar prints, Pedro, the one thing that I might say, especially on a medium probability trade, it's okay to get below that reversal bar. You could have been 1.5 points instead of 3.75 on risk, right? Because you're hoping that areas break. Does that make sense? It's okay to not leave it all hanging out on a medium probability trade, especially if it's starting to do what you want it to do. Because then what happens is you've got like virtually no risk. Maybe just a little bit on there. Does that make sense? I hope so. It's all right to move stops every now and then as long as you have a reason. As long as you have a reason to move stops, it's okay to move stops every now and then. Yikes. There's crude oil. Man, I need to do. You got it. You got it right there. And I love it because it's above that fib too, right? So hopefully this fib's holding as it pulls back to those synthetic triggers. I like everything about your trade. I really do. I think it's a great look. I think it's a solid look. And that 50-50 just kept dancing. I'm going to have to shut down and give my NinjaTrader a complete cleanup. Guys, if you're ever having NinjaTrader struggles, let me show you one of the things that's great to try is just, where is it? Deleting old charts templates. It's a pretty good one. Yeah, and I'm about to do that too. Repairing the database. In order to repair the database, you do have to disconnect. And then you have to go to your database management, and then you have to repair it, and you have to reset it. And sometimes that fixes things. And I'm not sure what's going on with my stuff today, but I am having a little challenges with my data. So I just did it. I just reset and repaired, and I'm reloading the data, and we'll see if it comes through smooth. Hopefully it does. And if it doesn't, that's okay. Class is almost over. We can find pictures. But all that stuff is in here, guys, giving you the opportunity to come through and learn how to do this stuff pretty easy. If you're brand new, I would encourage you go through and start clicking through pictures on this spreadsheet. Looking at all of the different trades, right? Understanding momentum and a clear path, identifying entries. It just makes it easier when the market's moving. And I want to show you something too. Perfect short. Absolutely perfect short. Got run over. Didn't work. But it's such a rules-based trade that it still made it into the spreadsheet. Perfect short. Didn't work. Sometimes they don't, guys. But if you can go through your checklist, allow the market to be wrong every now and then. Every now and then the market needs to be wrong. It just makes it happy to be wrong. Guys, is there anything else we can cover before we call it a day? You guys are so quiet today. And just a heads up, anybody, if you sent me a message, on Discord, I don't always get them here. I don't always get them in here. And then Chris T, I just noticed that was you. So we're there. Cav, have a good one, man. Grant, take care. Great momentum trades today. Beautiful. And then I'm still calculating, but it looks like it's coming through the way it's supposed to. We'll see how that works. Chris T, I'm glad you got in here. Sorry, guys. If anything ever happens that you can't get into Discord, Jason's your quickest bet, or your salesperson can get you in as well. Chris, sorry I missed that this morning. Here's one that didn't work. Waited for support to finally break. Reversal came just after trade entered. Pedro, I would take this trade every time. 100%. The only thing that I wouldn't do, Pedro, is I wouldn't put $150 a contract risk. And let me show you where my line of thinking is with that. One of the great things about what we do is we know exactly where the market should continue from, right? Look at that tiny little box, and your entry is perfect. The market shouldn't go here. Whoops, wrong one. If this trade's going to work, it shouldn't go to 65. And I want you to look. I want you to do a two-chart little look for me. Look at where 65 is on this chart. Look at how far on the wrong side of everything 65 is. Does that make sense? So 74, this is your entry. Would you really want to be in a trade short all the way up here? Everything would change by the time it got up there. Does that make sense, Pedro? I want you to embrace how good you are at this. No. You put your stop where you hoped it wouldn't go. I hope it won't go above resistance. Why wouldn't you use this resistance? Why wouldn't you say, my rule number 3 is designed to get me in where the market is most likely to continue. So if it goes beyond that window 4 or 5 ticks, I'll just exit the trade. But this is a couple of them, right? That's a $300 loss that could have been a $150 loss. And $150, what is that? That's, am I doing this right? Is that $3,000 a month at $150 a day? 3, 6, $750 a week. If you save that $750 a week, that's $3,000 a month that you may be able to save through stop placement. That's significant, isn't it? Sometimes that's how you have to think about it. And then here's the other side of it. Pedro, if you get stopped out for $150, well, that just means that you need to practice your stops. And there's a simple method, right? Where it should go, where it shouldn't go. You can do whatever you want. You really can. You can put as much risk on a trade as you want. It's not my place to tell you how. But if I'm in up here, there's no way in hell I'm leaving my stop all the way down here. I'm in this to make money. So if I get in up here, I'm out with the divergence, and now I'm waiting for everything to roll to give me another shot. I can take a trade twice. Isn't it better to lose $200 twice than to lose $350 twice, right? So you got to kind of think about it like that. Where is the market likely to continue? Where is the market likely to stop? Where is it likely to go? And use those really key phrases to give you an idea of where your stop placement goes. And you're going to get hit every now and then. It's a fact of it. You have to get hit every now and then. You have to be okay losing. You have to be okay with the idea that you just can't win them all. Nobody wins them all. Nobody I know has 100% winners. But what happens is you start getting pretty graceful on your losers. You start learning how to take losers with a little less problems. You start to learn how to take losers where they're small. They're not big losers. They're not aggressive losers. And that allows you to get more out of the winners, I think is the best way to put it. So good stuff. Really good stuff. I think it's pretty awesome when you guys post in the room. It's amazing how many lessons there are out there. There's amazing how many lessons you can come up with just from one picture. So good stuff. What's next, guys? What are we going to talk about? I'm still trying to make charts come up the way they're supposed to. I'm probably going to have to gut everything. But that's okay. That's okay. Are we done? Did we make it? Are we giving up today? I'm okay with that. We had a great day. We had a lot of great information. You guys participated like you were getting paid to do it. Life was great. Pictures were awesome. Lessons were plenty. And we'll just do it again tomorrow, guys. We'll come back tomorrow and we'll talk about advantages. We'll talk about entries. We'll talk about all the stuff. Yeah, so you just need to get them all in there. And remember, and I just closed it out, but I'm going to show you. Let me come through and go to scaling. Hey, Bob, thank you. Bob, let's start seeing some pictures from you, man. Let's get you fixed. If you want, I won't make you. But, man, I sure would like to help you if you're open to it. Hey, Rob, there's your scaling. Just reminding you how to get the charts to where you can see everything. There's the link to it. And that way, just making so that we can see the entries and the exits at the same time. It'll make it easier to give you a little feedback, and it'll give you a better tool to study as well. And then, guys, I'm going to call